Well, good morning, everybody.
Morning.
Hope everyone had a great Thanksgiving. We will call the Industrial Commission North Dakota to order. And the first order of business is the BND. Good morning. Good morning.
Morning. Joel.
And we've got first up, a bunch of audits.
Yep. We've got Jared from Bailey will present those.
Yeah, so
Only like 12 of them.
yeah, they'll be pretty quick though. So yeah, my name is Jared Mack. I'm a senior manager with Bailey in the Bismarck office. So the first audit we have on the agenda is the Ag Pace Fund. All the other funds listed below, I'll just lay them out in a group. We had clean opinions on all of those and no findings or no material non-compliance. There is one item to mention on Ag Pace Fund, so I'll go through that now. We had one finding laid out in the schedule of findings, improper recording of transfers. And what we laid out is the improper recording of gross transfers in and gross transfers out. They were netted on the financial statements. The total gross amount that was netted was $1 million. That came from Bank of North Dakota's undivided profits. This resulted in a material adjustment, audit adjustment, and material weakness in internal controls. The bank implemented corrective action by adding additional internal checks to their transfer worksheet to verify the correct amounts will be recorded in the future. The financial statements were adjusted to present that activity correctly, so we still gave a clean opinion on the financial statements. It was just that one finding.
And can you go one click more on what you found, Jared, in terms of how that happened, or what was the need for this transfer in, transfer out transaction?
So the need was just to fund the program to be able to fund future buy downs activity. So the financial statements weren't, the balance sheet was stated correctly. It was just the income statement, the transfers in and transfers out were netted. So they were presented as zero rather than a gross transfer in of $1 million and a gross transfer out of $1 million. It's really the Excel financial statements in the preparation process.
Rob, you want to address it? And I can.
Yeah, so the way it works, Governor, is, and we're working through this within the legislative languages, when we make a capital transfer into the PACE, in order to get it to like Ag Pace or to one of the other PACE accounts, we got to go through like 3 or 4 of the PACE funds. And so you transfer it in, you transfer it out from like Ag Pace to Flex Pace to its final home. And so when we built the financial statements, all the entries were done correctly. So the books and records were fine. But when we built the financial statements, we netted that $1 million in and out on that Ag Pace piece. But we're looking at the legislative language on the clarity of why do we have to go from, if we transfer $1 million and we want to get it to Fund X, why do we have to go from PACE to Ag Pace to kind of all the way through? It just seems like unnecessary accounting work and right for little errors.
Yeah,
like
so
this.
the legislation states that we can, as you look at an appropriation bill, it outlines various appropriations for all those funds, but it gives us authority to move funds where we need to. The way it's always done in the past is it's gone through whatever reason, it's gone from, like, it goes PACE and it's going to end up in Ag Pace, it goes out of there into there. And then, and so what we need to look at the legislation and say, are we interpreting it correctly? Or do we need to change legislation? Just says, hey, we don't need to go through these gyrations of going from this fund to this fund to this fund. It just gives us authority to transfer funds as we need it into all the programs. That's the bottom line. That's what happened.
Versus cascading it through.
Yep, cascading. Yep.
And so the amounts, Jared, were correct in and out. They were just showing net, so they didn't actually show the transfers.
Correct.
Okay, gotcha.
On one entry.
So this is, sounds like a function of the overall structure. PACE was created first. So
Yep.
once you created PACE, you put the money in there.
Yep.
But then they created Ag Pace and Flex Pace later on. So they still want you to transfer it all the way through. But, and you're right, unnecessary, but here's how you guys been doing it, because that's how it was first
Something we
structured.
got to look at.
We're going to look at it and say, do we need to either change legislation or we feel comfortable, we've got the controls in place where it won't happen again.
So we've got the clean audits and we have the ones, this, it was material because of its size, but it was a sort of a, we'll call it classification.
Yeah,
Right.
right. The balance sheet was still correct. The rest of the financials were correct.
So we got that. How do we evaluate whether these programs are actually working or not? Which is different than having, you can have a clean audit and then have a program that may or may not be actually doing what it was intended or actually achieving the goals it had. So what's the reporting that goes back to the legislative creators that come up with these things and then saddle the bank with the responsibility of managing them and operating them and maintaining them and auditing them? And there's a lot of work that goes into these. Some of these are relatively small programs.
Yeah, I would tell you that about 3 years ago, we had an independent review of this. We paid about 25,000 to talk about the impact of the PACE, specifically the PACE program. And I can bring that report to you, but over the top of my head, I mean, I think our return was, don't quote me on this, it was significantly more than the dollars we put in. And so we have that reporting and we do that. And then we can run these through a REMI model also to talk about what that looks like. So there is some independent reporting, not done by an auditor, but we analyze saying, what is the true impact of it? And I want to say a return for every dollar we invested, we got almost 1.8 multiplier on it, but we've got the data. We just need to
But
do
I've
that.
seen
We
that
review
I've
that.
seen that for PACE. I mean,
Yep.
PACE has been around,
Yep.
gets that attention, but when you get into like the, medical facilities or the addiction counselors or some
Yeah,
of these other ones, is it really our responsibility as the bank to be trying to figure out if these things are working or not? Or when the legislature creates them and funds them and asks you guys to do the loans, do they say somebody else is in charge?
yeah.
I mean, is Human Services reviewing whether the addiction loan program is working, or is it like not even their program because it
No.
came to you guys?
It comes to us, and then a lot of these programs depend upon whether they get funding or not. Like for medical infrastructure, that sunset, they were talking about putting some additional funds in there. If we don't have any funds, these are revolving funds. So if there's money that's available, then we go through the process of saying you have to apply. There's on certain ones that it does require the Department of Health, or like in the school construction, it takes those entities, DPI, to approve these. So there are the program guidelines do allow other agencies input on that, where we just basically administer it and do it. But we have not done a full-fledged, what I would say, review of saying what's our return on investment and those sorts of things. For each of these programs, we do for PACE, FLEC-FACE, in the beginning farm, we do. Yep.
And it may or may not be your governance responsibility or ours. I mean, it's
Yep.
like, as I'm sort of asking the broader question, because, I mean, some of these, the governance is so weak, but part of it's because they were set up as earmarks.
Well,
I mean, right? I mean, if you're getting a medical loan facility thing, it's not a broad base, we're gonna advertise to the whole state. I mean, people kind of know, well, this is the one who's gonna apply, and it's a way to drive dollars towards a specific location, but, shouldn't, I mean, what is our responsibility? I guess broader one I'm asking the industrial commission, what's the, for governance, or are we just, taking the bank's time to go through complicated ways to get money to some project?
I would tell you that most of these are revolving loan funds where there may have been a specific project involved, but a lot of them, there was specific need, like medical infrastructure that was set up when there was issues out in Western North Dakota where the rapid growth and couldn't get financing. So that's what that was. It was originally set up, so those funds had to go for Western North Dakota. Then the legislature came in and said, okay, that's kind of been done. Now we're going to open it up to the rest of the state. So it can change and evolve. And then there are various times, I know there was discussion this year whether there should be more money put into the medical infrastructure fund. So it does get reviewed each legislative session depending upon what it is. And one of the things we could do, Governor, is we could certainly take some time and really maybe go through, sit down and do some research and do a history of each of these and kind of a quick recap. I mean, we've got all the data on what they are, and we could certainly do that for you.
Well, I think we should.
Okay.
I mean, I'm not looking for a lot of work.
No.
But, year it started, what kind of governance there is it necessary? Who should be doing the governance? If not, I mean, because I don't want to load the bank. I mean, this thing could go from 12 to 24 depending on how, I mean, and it's like, that's a lot of, and how much of these are really have a great return like PACE and how others might have been trying to solve a specific problem in time and maybe we don't need them anymore.
Sure.
I mean, we're always looking for things to stop doing too, as opposed to,
Well, and some of these, I
Working
think back to Todd's point,
Yep.
you know, your addiction counselor and med facility, they don't have any dollars available, but they still have loans under repayment. And so, you know,
and we still have a huge shortage of addiction counselors.
Yeah.
So then you're kind of like, okay, who's,
Right.
Should that one be funded next year to allow more money for it? I mean, there's lots of different ways to look at it, but, and then the other thing, just so you know, these are all with the last legislative session. This is the last time you're gonna see this many.
that's why I'm asking.
Yep,
now.
and so now we're gonna, maybe they're happy, maybe they're not. Their fees are going down, but they're probably going, I don't have to deal with all these anymore. And
So
so,
these are gonna get rolled into the full
Yes.
bank audit.
and yes,
No,
and the-
those will get rolled into the capital audit for the state.
Okay.
But we still present all of this information is still presented in our quarterly performance highlights in our legislatively directed programs too,
Yep.
I think. So you'll have still some visibility and we can pull back that kind of overview history
Yeah.
and the activity for you.
They're about, sort of, they're gonna slide off the radar a little bit, at least in terms of,
Things specific.
Yes.
so I think it'd be good to sort of capture at this point of transition, sort of again, you know, the history of the program, are they whatever, and then maybe you guys have got some suggestions of who should actually be doing the governance on this thing. If you have turnover in other agencies, you could have, you know, could have a new HHS leader soon that wouldn't even know this program ever existed. They'll be trying to reinvent the wheel at a time when we need addiction counselors. Okay, well, thanks for that action item for that. And Bailey and Jared, thank you for how many years you guys been doing all these?
Recently, I think our two contracts combined is probably 9 years. And then there was a period where of 3 to 5 that we didn't do it, but we did it before then. So I think we're on a 9-year stretch now.
And so I'd have a role on anything related to bank on that, but not on these small funds.
Yeah, they'll still do the bank, the guarantor, the student loan trust,
Those three.
those three.
Good. Well, appreciate all the work. Tell your team, thank you.
Absolutely.
Thanks for being here today. Any
Thank
other
you.
questions on any of the other audits? Okay.
That's good.
All right, so going to non-confidential meeting minutes.
nothing really, unless you've got anything you want to cover on the Finance Advisory Board, then if you don't have any questions on that, the next thing that we go is we did get just a report on our Standard & Poor's credit rating. That is attachment 16. I'll just kind of kick it off. We remained at A+ stable, which is good. And, you know, maybe more importantly, why is this rating important? Two things I would tell you. It's an independent review of how the bank's performance is and how we're doing, our capital structure, all those sorts of things, and how healthy we are, which is important. The other thing that the really important factor is as these large projects come in and we get asked to do letters of credit, a lot of these large projects have obviously banks, large financial institutions that are outside the North Dakota that probably aren't aware of Bank of North Dakota. And if we're going to issue letters of credit as part of small part of the financing, those larger banks, instead of having to go and research, well, Bank of North Dakota, if we go, hey, listen, we've got an A+ stable credit rating, that really helps them understand that, yes, we have the capability and the ability to do that. And it really helps us all as we help provide backstops for even some of the community banks on some of the projects they do. It doesn't, from as far as issuing debt, we borrow from the Federal Home Loan Bank. That really doesn't affect us, doesn't give us a lower rate from them. It would if we'd ever issue bonds, but we haven't issued bonds for a long, long time and don't really anticipate it. So those would be the two, I guess, you know, the important reasons of why the importance of the S&P rating. And then I know maybe I'll have Rob maybe go into a little bit about, okay, because we always ask ourselves, and we ask them too, okay, how can we get a higher rating? What would it take for us to move up a notch? And then what are the things you're worried about us dropping a credit rating? So Rob, maybe just have you make a couple comments on that.
Yeah, and, you know, kind of just briefly, you know, if you turn to page 4, you know, they have kind of downside, upside scenario. So the upside scenario to increase the BND rating, an upgraded BND would require a 1-notch improvement in either the rating of the state of North Dakota or BND's standalone credit profile. The downside scenario, they state that they would lower the rating if either the standalone credit profile or their rating of the state fell by at least 3 notches. So certainly we're tied to the state because of the support and our, standalone credit profile, which you can see back on page 3, we get two notches above for just a strong capital earnings. So, overall bank is in very, very good condition, backed by the state. A couple of the key risks that they identify is geographic concentration, obviously, direct and indirect lending exposure to cyclical energy and agriculture, and then the subject to annual capital transfers to the state of North Dakota. But overall, very pleased with this rate.
I would say when
Key
we,
phrase on the last.
Yep.
Subject to the transfers.
Yeah, I think some of it's just the unpredictability.
Yes.
yep,
Yes.
it is, yep. And that's what we asked them, and that's what they say, every 2 years, you don't know how much they're gonna take out. So that unpredictability, that would be one of their, that they would say would be a concern. And then the other ones, it's hard for us to get out of, the ag and the energy. We are what we are. That's a big part of our economy. We are trying to diversify that a little bit by doing a little bit more out-of-state lending. And then lastly, the other thing is our lack of fee income, which the only fee income we really have is all those administered loan programs we do for them. We get 50 basis points. That's some of our fee income. Other than that, compared to other banks, we don't have credit card fees or cash management fees or any of that other stuff. We don't charge any service fees to the state agencies. We call eat all that or just cover all that. And so those would be the things, but they did say, the uncertainty of, and that's more, it's not the fact that there's capital transfers going out, it's the uncertainty of every year, you're not knowing how much it's going to be. Yep.
In that, the upside scenario is a one-notch improvement in the state of North Dakota.
Yep.
And the state of North Dakota gets dinged on their rating because of the fact that we don't flow SIF into general fund. The legislature has to transfer money to balance the budget, and it gets mentioned every time in the rating. And if we actually allowed the revenue to flow into the general fund account as opposed to doing this flows into a second checking account and then we transfer at the end, just that one change in accounting would shift us from being, you have more revenue than expenses as opposed to less revenue than expenses. And that could increase the rating, which then could help if you decide the list, and that affects political subdivision. So I guess I would say back to those of you that are participating on the cash management study, which I think, did you guys have your first meeting here recently?
We did. We actually had a meeting yesterday, again, and we made some pretty good progress on that.
I guess I would
Yep.
strongly encourage that group to have as a goal to increase the rating of the state of North Dakota. I mean, as a goal, because I think it could happen. And then secondarily, it could be help get the lift for the bank. And if we're in a period of extended high interest rates, this matters. And when interest rates
Yep.
are flat, who cares?
Yep.
And we're not, but now we're in a spot where it could really matter.
They look at concentration of risk as being a bad thing. When you are one of the few states in the United States that hasn't really skipped the beat in the last 15 years, it's been one of our strengths too.
Yeah.
So I get it.
Yep.
But my God, if we had our risk actually spread out, we'd have done much worse because the rest of the economy in other states have major issues.
I would say in spite of that, they would tell us we do a very, what they give us credit for is, Kirby and his team credit is we manage that risk very, very well.
Yep.
It's just that compared to other banks, it's not as diversified as you normally want. But we smile and go, we are what we are. We're not going to deviate from that. And we think we've done a pretty good job of managing that.
Don't apologize for it.
No.
Is this S&P annual?
And, yep.
Any other questions on the S&P? Hearing no other business from the team, then we'll move to a closed session.
I move that under the authority of the North Dakota Century Code, section 6-09-35, 34-04-18.4, 44-04-19.1, And 44-04-19.2, the Industrial Commission enter into an executive session for the purpose of Bank of North Dakota confidential business and to consider clean, sustainable energy authority confidentiality requests.
Second. Got a motion and a second. Take the vote.
Commissioner,
Yes.
Attorney General,
Yes.
Governor,
Yes. Motion carries. Commissioners meeting in executive session regarding B&D business pursuant to NDCC 6-09-35. Consider those items listed on the agenda under B&D confidential business. Only commission members or staff, commission staff, B&D staff will participate in that executive session. After the B&D executive session, the commission will meet in executive session to consider the Clean Sustainable Energy Authority confidentiality request. Only commission members, their staff, commission staff will participate in that executive session. Any formal action taken by the commission will occur after it reconvenes in open session. I remind commission members and those present in the executive sessions that the session is limited to the announced purposes, which are anticipated to last approximately 30 minutes. The executive session will begin at 9:26. Reconvene the North Dakota Industrial Commission. Good morning, Dave.
Morning.
You and your team had a great Thanksgiving. Thanks for being here this morning.
Absolutely. All right. So our first agenda item is a report from Kane Mitter on our bond trust fund.
we do have one.
I'm sorry.
item We need to take action on.
I'm sorry, I forgot that, Karen, but we have a, coming out of the, during the closed B&D session, there was no action taken, no votes required. After the B&D confidential session, we moved to the sustainable energy, where we reviewed 10 requests for confidentiality for clean sustainable energy grants. Is there a motion?
So move.
Second.
Okay, we have a motion and a second to grant the 10 confidential during the clean sustainable energy confidential session. Take the vote.
Commissioner,
Yes. And the, as part of that motion, Karen, you'll include the sections of code that grant us the authority to vote for those confidentiality requests as stated on your sheet there. Thank you. Okay, back to you, Dave.
Okay. All right. Our first presentation today is the bond trust performance that Kane Mitter here will do, and I'll let the gentlemen introduce themselves and go through their report.
I'm Ansel Kane. I've been with the firm for 15 years.
Victor Chang, I've been with Canada for 18 years.
Ansel, Victor, welcome to North Dakota.
Thank you very much. It's a pleasure to be here. So we are going to get started with just a brief overview of who we are. We're not a household name, so we figured that would be helpful. So if you turn to, here we go, the page with all the pictures on it. Slide 3, this is our team. We've got one of the deepest benches in the HFA space of municipal finance as far as municipal advisors go.
Housing finance agencies.
Exactly, housing finance agencies. So, and if you turn to page 4, a little overview on just how the HFA industry and us. So the circle in the middle is a graphic to describe all of the components that go into the complexity of municipal housing finance. Affordable housing finance it's both a form of structured finance, relying on capital markets, so multiple capital market sectors, and it's widely considered one of the most complicated sectors of municipal finance and fixed income finance in general. Our firm has been around for a long time, since 1978. We work with 29 state and local HFAs. They are located in every region throughout the United States. The firm, over 99% of what we do is affordable housing related. And we've, been ranked number 1 for the past 2 years by volume, by bond issues, or by both. If you turn to page 5, it gives a little overview of the different services that we offer to HFAs, and it lists all of the different clients that we currently have. So a couple points here. So when you're a financial advisor, most of our main job is to assist a housing finance agency negotiate with Wall Street and get the best possible price, the best execution, the lowest cost of funds. In housing, because it's so complex, the financial advisor puts the deals together. We structure the deals. We kind of bring a lot of the ideas to the table. We work in partnership with each HFA, and our role is different in every single state. And you can see that by the number of dots in each column. You'll notice that where we actually emphasize a lot of our resources in the quant section, that orange section, we do not provide those services to North Dakota Housing. And that's because North Dakota Housing is among the few HFAs that has the sophistication to perform those services in-house. So that's it. We're going to talk a lot about distinctions between North Dakota and other states today and where you kind of stack up. And I think that's a key point, is the level of sophistication and the amount of work that staff is able to retain and perform within the state. On page 6, going back to just the different, comparing to other states, there are basically two ways that affordable single-family housing is financed. One is through the MRB, or Mortgage Revenue Bond primary market. It means selling tax-exempt or taxable bonds, using those proceeds to purchase mortgage loans or mortgage-backed securities. It's structured finance, so the MBSs are held on balance sheet, and they are the revenues from the MBS or whole loans go to pay down the bonds. The other model is the mortgage-backed securities secondary market, or the MBS secondary market. So that's the model that traditional commercial lenders use. So making loans, purchasing them, packaging them into MBSs, and then selling them to investors. So it's an off-balance sheet financing mechanism. One of the key distinctions, and we'll come back to this point later when talking about how different states' capital structures work out, is that when you sell an MBS, you basically take your profits or the income, you're making a point or half a point to 2 points on every loan, and that income is earned short after origination. For a mortgage revenue bond program, there's actually an investment because there's a cost to issuing bonds. Those bonds are put on balance sheet, and the spread income that's earned between the receipts of the revenue generated on the mortgages versus the debt service paid on the bonds is how the HFA generates income to cover its costs.
You get that spread income over time, but you're taking more risk over that length of time.
Right. You retain the prepayment risk, you retain the delinquency and foreclosure risk, and so on and so forth. You also retain a lot more of the value. So the map on the right shows, and it's kind of a heat chart. So if it's a state that's shaded a lighter color, is more heavily focused on single-family financing through selling MBSs, and the darker colored states are states that are more heavily focused on holding MBSs or mortgage loans on balance sheet and financing them over time. North Dakota, you can see, is very much it's very focused, although it does have access to the TBA or MBS secondary market. Most of its loans are financed on balance sheet and held trust.
So this slide is comparing how the agency provides added value to traditional HFA benefits. So traditional HFA benefits their bread and butter is providing below market interest rates for first-time home buyers, and also providing down payment and closing cost assistance. It's an important key that they're an additional secondary market for in-state mortgages, and they focus on also providing opportunities for underserved populations, so veterans, rural areas, etc. The agency here also is, as Ansel said, they're one of the only HFAs in the country that can issue mortgage revenue bonds and fund whole loans rather than funding MBSs. And there's an additional level of control that the agency is able to retain by financing whole loans. In addition to being able to sell mortgages, MBSs to the secondary market. So they have two avenues to which they can both serve the mission and earn income. They have a program that provides down payment assistance to non-first-time home buyers. Another key benefit is that they self-service. They're one of I think there are 12 different self-servicers that are in the country, and all the loan servicing is retained in the state. So not only is it, income that stays in the state, but it also provides the agency with another level of control. They also serve as a complement to lenders. There's no cross-selling of banking services, which has been is frequently a complaint of lenders in other states. There are no additional overlays and fees that they add on, and then they have the ability to roll out targeted programs for single parents, vets, senior citizens, and disabled citizens. So this slide shows the rate benefit that the agency has been able to provide to borrowers. This goes back to 2007, just this chart, but you can see that as interest rates have increased over the past 3 years, the rate benefit has increased. So in 2023, the agency's averaging about a 1% benefit in terms of a lower mortgage rate to borrowers. In 2022, it was 65 basis points. So the higher the interest rates go, the more the benefit. Tax exemption from bonds that the agency can then pass on to borrowers. So over the past 20 years, the agency has been able to $1 million down payment and closing cost assistance. The past 5 years, they've averaged about $10 million of this value assistance per year. This is a huge roadblock that is very valuable for first-time homebuyers to get into it.
Do we have a sense of what the total market size for down payment and closing costs would be in the state and what percentage this would represent? I mean, this is.
Interesting question. We don't have a number for you.
Could we get it? Could we get it somehow? I mean, can we assess the market? We should be able to figure out all the, I mean, in a given year. I mean, I guess I'm trying to understand, I mean, because we're performing this high, which has always been our sense. And then we've always had in the budget a larger number for housing finance than what the legislature gives us. And then some of the information here would show that this is a high performing organization. Wouldn't we want to give it more funding, but it's also back to what is the market share? What's the market share we have? I mean, does this represent 1%? I mean, are we involved in 1% of the deals? Are we involved in 3% or 5% or?
Well, there's a slide later on that talks about our penetration, but for just specifically down payment closing cost assistance, I don't think there's another program in the state other than ours.
Right, the two programs we have, right, Brandon?
Like City of Fargo and City of Grand Forks have had them in the past, but they both stopped doing those. So, and because we offer it for both first-time home buyers and non-first-time home buyers, I think that's pretty much the market because there's only the down payment programs become very localized.
I get we have 100% of the program activity, but I'm wondering is 100 and just if it's 10 million last year, let's just go say 10 million last year of assistance, what was the total amount of down payment and closing costs?
Oh,
For all transactions in the whole state.
Yeah, okay, now I understand.
We knocked off 1% of that cost for X number of buyers, or did we do 2% or 5%? Or I'm trying to understand the whole, because this number shows what we've done. The market has also changed over this period of time as well. So I'm trying to get what our market share is.
Yeah. We could get something, a number there. Because, you know, we know how many loans were done in outside of our own. And then you just extrapolate out what the normal costs are. So, you know,
Yeah, number of closings in a year and how many we participated in would be another way to do it, but this would be the actual dollars, not just the number of closings.
The agency continues its network of vendor relationships. So currently they have 50, 41 in-state and 9 national. So these next, on slide 11, the next.
Help me understand do we think on the 41 state, this is good or bad again on market share? I mean, how many lenders are offering mortgages in the state of North Dakota? I mean, is it 100, 200, 300? I mean, again, what's our market share?
there's well over, you know, we can get that number from DFI, but there's well over what we have. But you have, most of the lenders that are active in the mortgage space do business with us. I don't think there's probably a handful. We'll have some mortgage brokers don't participate with us because they have, under our program, they have to take on where they have to fund the loan up front themselves, and then we buy it from them. And a lot of the brokers don't have the cash to do that. Don't want to get to that point
Yep.
either. So they'll just work with another secondary markets then.
But not for today, but maybe for our own team, because between DFI and the Bank of North Dakota, we could take a look at these 41 lenders and go, are we missing anybody?
We haven't looked at that in a long time. I don't know, Brandon, how many have we added in the last year?
Last year, probably, I mean, we're probably adding 6 a year on average.
Yeah, well, let's just take a look and see if there's anybody that we're missing that we might have an existing relationship with through B and D that we should go.
We, actually, when B&D transferred stuff over to us,
You picked up a few then.
there was
servicing
only,
side.
there was only like 3 that weren't with us. That were B&D. So, and we picked those up, so.
And they gave us our list of who they were using. We did reach out to all of them as well, letting them know that, you know, we have
Okay.
this service. as well.
All right.
Okay, so now comparing the agency against other states, using information we've gotten from either Moody's or the National Council of State Housing Agencies, which is their trade organization. So this slide shows their market penetration. The agency has consistently been among the highest of all state HFAs in terms of their market penetration. In 2021, they were number 3 in terms of the ranking. And that relates to, if you go to the next slide.
Who's that crazy line up on top?
That's Alaska. So because they have such a small population,
Oh,
there's
easily distorted.
And then who's number 2 that shot up in between 18 and 2021?
that was Idaho. Yeah, Idaho had a big increase over the past few years as well.
Idaho is they're not a state agency. It's Idaho Housing Finance Association. So they're like a quasi-government entity. And Alaska is too, right?
Yes, that's right.
Yeah.
I'm sorry, I have the numbers back. The next slide shows you Idaho is number 1, Alaska is number 2.
Idaho also has become ballooned into a major servicer for housing finance agencies nationwide. It's very rare for an HFA to service their own mortgages like North Dakota does. And there are a very limited number of servicers that will perform that role for state HFAs. And so Idaho kind of filled a gap in the market and began offering their servicing resources to other states. And they've kind of grown incrementally over time, but it's you can see it's an exponential phenomenon.
So that may not necessarily reflect what's happening in their state. It's showing the amount of activity that they're involved in.
It's within their state, but it speaks to just they've become basically a major mortgage corporation. They almost offer operate like a fully independent business. And I think the fact that they have spread their reach so far has really, changed the way that they do business.
I think maybe the point there is that they have more resources because they're servicing 150,000 loans.
Oh,
So it's a huge operation, and that has provided them with other resources that then they can put back into their state programs. So like the governor said, how much more down payment assistance could be provided? Well, that's maybe something that they're doing, bringing in some more business in Idaho.
I see.
But then also all those lenders, they've got such a good relationship with their lenders in Idaho. That's where they're sending their loans to.
Okay, I get it now.
Slide 13 shows profitability. This is a key metric that Moody's the rating agency does. It's net revenues divided by total revenues. And so the key here is that the agency has been able to operate one of the most efficient single-family programs consistently. So going back to the data that they're consistently among the top HFAs. It has fluctuated from as high as number 8 to the last time we had this, it was number 23. And that's part of that is due to the agency's growth in terms of the amount of loan production they've been doing. And as Ansel said before, it's an investment of funds because it costs money to issue the bonds, and then that will be repaid.
And you can just see there's most of these lines are fairly volatile, right? There's a lot of movement from one year to the next, and that has a lot to do with shifting between MRB, mortgage revenue bond, and MBS, selling MBSs. And so that, I think one of the things that really stands out about North Dakota housing is their consistency.
And what about like Alabama and Virginia? If they're showing these super high percentages, are they making too much money in this business? I mean, what's the,
Well,
there's such a thing, but I mean,
yeah,
it's like, what's their mission?
Yeah. Well, Alabama, again, like Idaho, they're servicing loans for other states. So again, a lot of resources. Virginia is just huge. And they also originate mortgage loans directly in certain areas of their state. They actually have I don't know if they still have it, but they have like an RV that they go out into rural Virginia and will take loan applications. So they have a mobile origination lab, they call it, I think. So those two states are again different like Idaho is, because they've grown beyond their borders, so to speak.
You guys could just do it in a pickup. You wouldn't need a.
Yeah. We take our personal vehicles out.
Just sign on the hood.
Yeah.
Do they still have that?
I don't know. I don't know that they RV, but I did actually. We work with Virginia, and I did actually meet with the Secretary of, I think it's Commerce the governor's administration there on that exact point. There was were they not utilizing their resources effectively because they're making they're so profitable? And the answer is they've got a multi-billion-dollar balance sheet. They're really capital intensive. They are also one of the few self-servicers. So and they keep a lot of stuff on balance sheet. So again, it's one of the not to be trite, but it takes money to make money, kind of, and having that investment and being able to shore up your balance sheet is critical in that model, but it's also much more profitable over the long term.
So this is on 14 with us being kind of in the middle of the pack. We should be, this is comparing different business models to each other.
Some of it
And
is.
it's not a pure performance indicator.
And as Ansel indicated, a lot of those lines are up and down, and that's how they've switched on how they do business. And that's it.
the black line on 13 versus the teal line. The teal line is North Dakota. The black line is at the median
Yes.
for everybody.
Yeah, and that consistency is, state HFAs are not, private sector lenders, right? So when there's booms and busts in the mortgage market, there's, hiring, doubling of staff, and then laying off, due to huge layoffs when interest rates shoot up, that having a consistent revenue model is it's a powerful resource for a state entity.
So on 15, this is the fund balance. So net assets as a percent of bonds outstanding. Again, North Dakota has been extremely consistent here, and they're right along the median. They have been for a long time. And so basically it's showing that they're leaning in and using their capital efficiently. They're not accumulating, you're not accumulating excess wealth, and you're deploying capital as efficiently as possible. Your single family program indenture is rated AA1 by Moody's, and so only 6 HFAs with whole loan programs have higher ratings than normal. On 17, you can see how low your delinquencies and foreclosures are as a percent of loans. It's consistently, among the best performing in the country. Here as well, you were the third lowest among all HFAs. So on slide 19, I just wanted to briefly touch on these, their fund balance criteria and how they come to be able to rate you all AA1. On the left side is what they call their PATR, parity asset to debt ratio. It's basically the asset to liability ratio. And the key here is that for a AA1 rating, they require that the indenture or the resolution maintain a 104% asset to PATR. And then on the right, it talks about their loan loss model. So they evaluate your portfolio every year. The agency provides them with a lot of loan data in terms of the performance of the loans. And they run it through their model. And basically, for your active indenture, your 1994 indenture, they haircut the value of all those loans by 3.8%. So they take all your assets, they take the whole loans, they skim off 4%. And then after that haircut, you still have to have a 104 in order to maintain the AA1 rating. This next slide just lays out a lot of the cash flow projections and stresses that the agency, again, does in-house. Very complicated sets of cash flow projections because housing has so many different moving parts and different assumptions that the rating agencies require. A couple of key ones here are that they make you assume high interest rates, low interest rates, high prepayment speeds, low prepayment speeds, and they stress. They look at all your counterparties, if you have investments, interest rate swap agreements, and they can stress, require that you have the capital to maintain stress scenarios there as well. And events that would increase cash flow stresses would be volume growth of the agency's program. This is something that the agency is very much maintaining and managing as their volume does grow. A shift in mortgage insurance, if more private mortgage insurance is originated versus government mortgage insurance, because PMIs are not rated well by Moody's, so they'll increase the loan loss haircuts. And then downgrades can happen and require more capital.
Seems like they're missing a component here. Delinquencies and foreclosures are a source of revenue and stability. They kind of disregard it.
Yeah, they deal with that in mostly with the loan loss haircut on asset to liability ratio, but then in the cash, so they don't really, they try not to double count it. But they do have a lot of they do count the most of the insurance coming through and eventually being able to pay the assets off. Okay. There are states that have had really high levels of delinquencies and foreclosures, especially coming into the financial crisis. And so Moody's and other rating agencies had required some HFAs to have very stressful additional cash flow stress runs. Saying, okay, we want 30% of these types of loans, just assume defaults, 30% of these types to go into delinquency for a period of 3 years, and the cash flow is but because the agency's performance has been so good, you were never required to run those types of
That's why we don't, okay. Because I thought we'd be subject to it if we had it set art in other places, but okay.
I get go, Victor, is that the 3% haircut. You know, so they're saying that's like, that would be your foreclosure rate in essence, and really our foreclosure rate is below 1%.
Exactly.
Well below. So we're actually getting hit harder than what, 40 years of reality is.
Right. Yeah, and we'll see on this slide on the fund balance side, it's closer to 4% of the haircut. And so it's not only it's the loan losses associated with moving a loan throughout the it's all the expenses, improvement of your asset.
Punished for doing well.
So on 21, this is on the first row that shows the net assets from your on financials as of 6/30 this year. And it, on first glance, if you look at the combined total of 232 million, a ton of excess cash or excess assets here. But I just wanted to run through this. So you don't really have all of that available to just withdraw and use for other purposes. The first set of assets that are not really available are just, we classify them as accounting items. So due from HUD, basically you're administering federal funds that just kind of go in and out. Other, accounting items like prepaid expenses, etc. So of the agency's operating funds, the 14 million of excess assets after we account for those, there's really about 3.3 million of excess. The 1994 resolution, which is your, kind of the agency's bread and butter, there's 195 million of net assets. But the pre-funding of other obligations includes about 9 million of operating expenses, 1.5 million that they keep available to lend to the community land trust. And then the big haircuts here, or not haircuts, but the big use of capital here is 4% for the Moody's patter requirement. So that's 62 million that they have to have in order to maintain the rating. 58 million to account for the 3.8% loan loss haircut. And then 8.7 million for additional counterparty requirements. So that is a big use of the net assets to maintain the rating. And then below that, there's about $50 million of assets that are basically earmarked for the next year's bond issuances. And the big things here are when you do additional bonds, you have to again account for the 4% of Moody's patter, which is 17 million, loan loss, which is 16 million, and then additional stresses. So all the Moody's requirements total about 36 million. You can see the line item for down payment and closing cost assistance, that's 7.6 million. So that's the bulk of that section there. So
Is there a different rating company? I mean, these guys might know their business in every place else. This seems a bit unfair when you start looking through this and how they're scoring it, how they structure it, how they consider it.
So S&P is another one. They have a very similar methodology. But AA1 is, there's only AAA that's better. So these are very purposefully stressful. Other than the federal government at AAA, right? I mean, this is way up there in terms of currency.
Federal government gets stripped.
By one of them.
One of them over 29 million trillion in debt, and they get a AAA.
Oh, we don't want to be AAA because you can imagine what the requirements are.
Well,
You gotta
then,
maintain
yeah,
them.
great,
Yeah.
great.
And you don't want to downgrade.
Great point.
Yeah, the pattern requirement for AAA for whole loan jumps up from 104 to 110. And so that would just,
But you have access to credit that a typical, or the North Dakota Housing has access to credit that a typical mortgage lender would not, because of its rating.
yeah, and you pay lower fees, not only of that access, but the fees that you pay are lower because of your strong credit rating.
Right. And then mortgage revenue bond market for single family basically functions in the AA to AAA category. Single A, once you drop to single A, it's there's a significant penalty on pricing. So maintaining the rating is important.
So what you're saying is we're probably in the sweet spot.
Yes.
Yeah.
Okay.
The 2009 resolution is basically a runoff. You're not doing any new production there. So, there's 22 million of net assets as of 6/30. About 3 million is required to maintain the rating, and then there's about 18 million of excess there. But I think that eventually that indenture will probably be collapsed and refunded, and combined into all the net assets will go into the 94 resolution to help shore that up and continue volume growth. So this just takes, we're just looking at the cash balances on slide 22, where it looks like you have 229 million of cash just kind of floating around, but some of this is funds held in trust for, borrower escrow payments, so that's not really, the agency's cash. And then in the 94 resolution, of the 187 million of cash, about 87 million is used to pay down debt. So the bond debt service payment that's due in July 1, what totaled 65 million, 17 million was mortgage payments that will be deployed to call bonds, and then bond costs totaling about 4 million. 60 million of that was just money. They had just done a bond issue recently, so that was cash that was going to be used to purchase mortgage loans in the coming months. And 7 million was for the debt service reserve fund. So we end up with about 22 million of available cash. And then the 09 resolution, there's not much there. That's continues to be a rundown, lean and mean, using, cash that comes in basically is used to call bonds.
From a macro statement or macro strategy standpoint, we've got cash laying everywhere in the state of North Dakota. We're just initiating finally a cash management study, which for context, when I say finally, because the executive branch has been asking for it for some time. Legislature likes hiding stuff in cream cans, little pockets around whatever. And that was, could survive when you had a period of low interest rates. But now when we've got a period of low interest rates and we've got a bunch of cash that's not being invested at its optimal level, for short term or long term, we've got, if we were ever at risk of not maintaining this, and if you could transfer cash from someplace where it's earning nothing to help shore up a balance sheet here at North Dakota Housing Finance, and just sit there on the bottom of the stack and then help make all these ratios, you're never sweating it. That would be a better return than some of the other places we've got it just sitting, earning nothing. Right. Literally earning nothing, because sometimes we turn around and invest it in our own Bank of North Dakota, and then the Bank of North Dakota is a monopoly that doesn't have to, pay the kind of rates on a money market fund. And so then you could, you end up, the agencies get almost nothing for their cash. It shows up later as profitability in the Bank of North Dakota, but it seems like this is one area that we should probably be looking at in the cash management study. I'm looking at Karen and the B&D group, but we ought to include NDFA on this, because there could be an opportunity at some point where you'd say, hey, rather than risk any kind of risk relative to a bond rating change, just to have more cash housed here as part of the appropriation. And I see nodding in the back row. Is that right? Well,
Or Kayla, yeah.
yeah,
We would love that, yeah,
Yeah.
because it would help with our pattern concerns as we grow. If we could do something to get additional cash. I will say, a lot of our money that you're talking about here, our excess cash, is invested in Goldman Sachs,
Yep.
which we are getting 5% on. The portion that's escrow, about the 22 million, that
Yeah.
is at B&D. So
Yes.
we're getting 0.25.
there's a difference between those two numbers.
Significant, yes.
We did, Kayla did an analysis of the last 6 years.
Yeah,
And the difference between interest rates during that time, which was low rates and now higher rates, it would have funded 6 years worth of our agency grant programs, for instance, Helping Hand and the Rehab Accessibility Program would have funded that six years just from that interest on that smaller amount of funds.
If
So it
there's
does make a big difference.
And if there's a longer term investment horizon, rather than just having it be liquid, that cash from other parts of the state could be housed at the agency, could be used to kind of serve a double purpose. You let the agency buy MBSs, and then you're earning a rate of, today's rate's like 6-7%.
Yes.
And so still serve the mission.
Yeah, because we've got rainy day funds that are over reserved and then double reserved, and they're all in super short term, and there's no chance, even with the legislation, you can't even access the whole stack in the rainy day fund, because to start accessing it, you can only access it if you start cutting spending across the board at the state level. They won't just let you cover losses. You got to start cutting spending to do it. So it's almost mathematically impossible to get to the bottom of that stack. And that one's got 907, that one has 975 million in it. We've got another one that's got about 500 million in it when I say double reserve, because that's just 12. And that one has got a flow of funds coming in from the oil and gas funds that make that almost impossible in almost any stress testing that you'd ever get to the bottom of that stack. So there's two places you could go right away at the bottom of those stacks and say the return would be higher if that money wasn't sitting in the bottom of the rainy day fund or the foundation aid stabilization fund, but chunk of it was sitting with you guys. Then, that would be accessing the kind of returns that Victor's talking about. So anyway, we've got to add this, bring this team into the cash management study.
We welcome it.
Yeah, and if we do that right, we also have a chance to increase the rating for North Dakota, because North Dakota's rating, given the size of our balance sheet, should be higher, but because of all of these funds that we have, require then a transfer to quote balance the budget at the end versus it just flowing into a general fund. It gets diverted into a bunch of side buckets and then has to be voted on to come in, and then that affects.
Gov, you're putting more items onto the already underfunded cash management.
Okay.
Okay, so this slide really just highlights what we've already done. Don't want to be too repetitive, but yeah, I mean, really the keys here are consistency over the past couple of decades, efficiency in terms of consistent of high market penetration, that fund balance that it's still very profitable, and the sophistication again that Ansel touched on.
And then we have a couple of slides, or 3 slides on some recent market trends. So the first graph on this page are the benchmark indices that are, we look to the most in our industry. So the 2 green lines, I'm sure you're aware of those. Those are the taxable benchmarks, Fed funds, and the 10-year U.S. Treasury. The 2 blue lines, or the blue and the black line, are SIFMA. That's the one that looks like my 5-year-old scribbled on the chart, and which is the short-term index, tax-exempt index, and the 10-year MMD, which is the tax-exempt long-term benchmark index. In the lower left, you can see a snapshot of the yield curves, Treasury curve, and the tax-exempt benchmark curve. Those are the green and the blue lines. In the lower left, that's so rather than going over time, we're looking at one day as of last week, how much it would cost to borrow for different periods of time. So you can see that the U.S. Treasury curve is very inverted, not as inverted as it was a month ago. MMD is also inverted, but the mortgage revenue bond yield curve is just basically does not get inverted. It always costs more to borrow for longer. And part of that is the optionality that gets built into mortgage revenue bonds. There's a prepayment redemption provision similar to a mortgage. And then in the lower right, the value of tax exemption is captured by these lines, also represent yield curves. They're basically the ratio of the blue line to the green line in the lower left. So currently ratios are low, and which is helpful. That means that there's more benefit to tax exemption for a borrower, less benefit for an investor.
Is there a very quick explanation on the high volatility of SIFMA?
Yeah, so there's a couple things. So one, there's been a drastic reduction in the amount of outstanding variable rate debt outstanding issued by municipalities, so there's just a smaller market, which means it's more supply and demand should have a bigger impact. And there's always been it's never been the most consistent, like it doesn't follow Fed funds exactly. Even when there was a lot of supply, people tend to want to be in cash rather than a short-term investment like SIFMA, like a VRDO or tax-exempt bond on their balance sheet when they report either financial reporting or when they often, for high net worth investors, when it's time to pay, when tax day comes around, so like right in April, you'll see like a big spike in rates because people sell their VRDOs, pay the feds, and then it will stabilize over time. If you look at any sort of even 6-month period, there's a very consistent percentage of 60 to 70% so
It's very predictable. I wish I had a commodity market like this. I'd invest all the time.
yeah.
Buy low, sell high. And wait another 6 months, buy low, sell high.
On page 25, we put so we've got FOMC predictions from the September 20th. What's known as their dot plot. So you can see, rates essentially. Most of the FOMC committee members believe that rates are close to having peaked, and so there is a strong expectation both within the FOMC and the market the broader market as a whole that rates will begin to decline in 2024. I do want to emphasize that our role working with HFAs and HFAs in general is not to be in the rate predicting business, but to be able to provide affordability in any interest rate environment. And North Dakota has a proven record of doing that. So they're well positioned either way. It is true that when interest rates are high, the value of tax exemption is greater. And so right now is a particularly beneficial time for HFAs. And that's captured on page 26. So the orange line, so this is charts the one mortgage product. So sort of generic, not North Dakota Housing's per se, but a generic mortgage product that would be offered by an HFA that has probably FHA insurance and includes a down payment assistance component. And it tracks the rate on that loan if the HFA had either sold it in the secondary market, finance it with taxable bonds on balance sheet, or to finance it with tax exempt bonds on balance sheet. So the orange line is the sale in the secondary market, green is on balance sheet taxable, and black is on balance sheet tax exempt. You can see that as rates have risen, the black line has all rates have gone up, but the black line has significantly diverged from the orange line. The orange line is not necessarily a private sector mortgage, but it is functioning off of the private sector's cost of funds. And so therefore it is an indication of how much value North Dakota Housing is bringing to the table. The Roots program that North Dakota Housing offers is not eligible for tax exemption. So that's done through taxable financing, Green Line. And there's been a lot of that. There's been more opportunity to provide value there over the past year. Any questions? Any more questions?
Well, great report. I guess the last question I have is, do you have to be a Blue Devil to get a job at your firm, or is that a helpful thing or a requirement?
It doesn't hurt.
Okay, well, I'd say, I think Ansel and Victor, we were looking back to 2004 since it came in, or was on our account. Victor's been there since 2005. And Ansel's been around, but no, you're kind of taking over for Tom on our account. So we're looking forward to working with him, but a great relationship in the last 20 years now. We just realized that we were sitting talking, it's going to be 20 years next year.
From your perspective, I mean, the summary is like, obviously it's great for us in a governance mode to get the feedback or affirm what we know, which we've got a great agency that's doing great work, but to have the benchmarking on the other states is super helpful. So grateful that you guys have got the perspective and can provide that. But is there any advice that you'd have strategically, like we talked a little bit about, about the opportunities that we might have in some of these other states, and we got capital sitting around that's earning nothing, and you could be earning higher returns here. I think Doug missed it. Share of the year Goldman Sachs versus Bank of North Dakota numbers.
So, yeah, for Goldman Sachs, we're in a money market account. We get about 4.8 to 5% recently, and at B&D, we get 0.25.
But, which is, I mean, we make it up on profits, supposedly on B&D, but if those profits go into a checking account as opposed to go back to you, I mean, that would be, because Dave, share your thing that Doug missed too, about how much, 6 years you could have funded.
Well, just that difference in the last 6 years.
Yeah.
Would have funded our helping hand and rehab accessibility program for all 6 of
That
those
we
years.
had to pay
So we
to
would
get
get doubled.
appropriation.
We could have doubled.
Yeah.
What we did there. Well, that's still coming out of the agency.
Well, yeah, but you have
But
to,
we could
The
have
rate would
doubled
have
what
been
we
different
did
though,
there.
right? I mean, the rate would have been Dave. There would have been the 4 point.
Right, and we took
Yeah.
that into account through
Oh, I
years
see.
because we had the history with
I see.
like Goldman Sachs.
Okay.
Yeah.
Right.
And there actually was a year that I think B&D was better, and that was in fiscal year 20 or 21, and that was COVID, so.
I mean, particularly if you don't have a program or a need that those funds, that you want to allocate those funds for now, the North Dakota Housing is a great way, and Victor, touched on this, because not only would the funds be invested at higher returns, but a good chance that they'd be leveraged, producing more income over time, providing more, affordable housing, but at a profit, like not the, North Dakota Housing within the indenture isn't, even the down payment assistance program isn't giving money away. It's investing, but getting,
And it all ties back to workforce, because the big issue we have in our state is that, people move here and then they can't find housing. I mean, like, the jobs are here, I'll come to North Dakota, but, can I get childcare and can I get a house? Those are two things people want to know. And this is workforce infrastructure as part of what we're talking about here. Because then we get them here and they get a mortgage, then they're going to stay and raise a family and
continue to support the economy.
Yeah, in their communities and.
There's a great opportunity, like, in that last chart, that green line, so for workforce housing typically does not meet the tax exemption requirements. And so, there are opportunities right now to make that work, and with a little extra, capital, do interesting things.
But I know you're using the term specifically workforce housing, but I'm saying affordable housing is workforce housing in North Dakota, because if you're here and you're in, there are certain situations where affordable housing may be for disabled vets or something, but there's other places where a lot of people are actually working.
Retail and
I mean, we have
service.
the highest workforce participation in the nation at 70% in North Dakota, and we have a lot of people that are working not 1 but 2 jobs in our state, and they need places to live. And as we talked about under the B thing, we went from $104 million of loan activity in the Fargo Moorhead multifamily market last year in fourth quarter, and it was 4 million this year. So the Fed is working its magic to bring construction to a crashing halt.
Yeah, I mean, we talked to Dave's team regularly. There's, we have ideas. They've heard them. We're very focused on efficiency, and we're really capital markets advisors. And as opportunities arise, if the capital's at hand, then we rely on these guys to take advantage.
One thing, I mean, I think this is more of a legislative issue, but just the flexibility to hire more FTEs or to have the ability to pay closer to market would provide the agency a lot more flexibility in order to attract talent, retain talent. I think those are issues that several HFAs around the country, most HFAs are more quasi-independent than really part of the government and have those restrictions. But this is the few HFAs that do have those restrictions. It's a common refrain that this is really things could be more efficient by having a little bit more flexibility.
I agree 100%. We've been saying that for the longest time. Give us a budget for salaries, appropriate accordingly. It's up to us to fill those spots and make it work. Stop worrying about how many FTEs we have. We could do it better.
Our funds are not general funds. As you see, it's all agency revenue, and that the flexibility would be nice to have, obviously.
Bank of North Dakota and State Mill and Elevator, we got the same problem.
Yeah.
They use their own funds too, and we got to battle those appropriators over this.
Well, we have an opportunity maybe here, Doug, on that sentiment, which is under NDIC, because we're making progress relative to B&D and the mill on market rate, in terms of how we're comping. And we continue to have those discussions, but given that now that you've taken over B&D's loan servicing, I mean, there's other stuff you're doing. We should really treat housing finance like B&D in the same umbrella of that you guys are competing for talent at the market level. And we do have even though we might have gone backwards on the FTE, we are on the FTE pooling thing the legislature came up with, which has created more problems than it solved. But HHS is not in that program, and the whole objective of HHS is to prove out for all agencies that we do not need the FTE thing. Because you could give us thousands of FTEs and we wouldn't be able to fill them because of the market forces. I mean, it's no longer a gating factor to control spending. It's just some goofball number that in a world of labor shortage, it's not a factor. I mean,
Yeah.
right?
Yeah.
I mean, you want to slow hiring, then keep fixing the salaries that we can pay. You could have 1 million FTEs for the state of North Dakota. You couldn't fill them. I mean, not if we're controlled on what you could spend on the thing. So it's back to what you're saying, Doug, which is you got to, have the salary line is the gating factor, not the FTE line.
That's right. Stop worrying about people criticizing you and saying you're growing government. Actually, there's ways in which we could cut government, provide better service, and overall the public. That's what we're supposed to be doing.
Yeah, I mean, just this net revenues is percentage of total net revenues. We work with, just to name a few, Virginia for two, and Oregon Housing. Virginia is perhaps one of the most independent HFAs. They're right at the top. Oregon is perhaps the most constrained by red tape within, basically anything they do requires a change in statute. They want to make in any different direction. They're very, very, very constrained. And so there's definitely a correlation between, independence and
Okay, well, great.
Just a couple things tie into that. We purchased our 50,000th first time homebuyer loan this fall. And that was, so we've issued over 4.8 billion in bonds, and actually that's just direct purchases. And we actually issued it's probably closer to 7 billion by now in bonds over our life. So, and we're servicing 12,000 loans, which is the largest number we've ever done. And then, our net assets are hit over 2 billion, on that. So a couple milestones there.
Fantastic. I guess one action item, we've got strategic planning coming up. Would love to incorporate some of this into the strategic planning process. And then, of course, as you know, we have tried and failed in the executive budget to get a larger amount appropriated to, the housing incentive fund. And I don't want to have that, I don't want to come up short again next year. So we've got to build a stronger presentation, and in terms of how that gets into the executive budget and coming out of the strategic planning, and then think about how we can start educating key legislators before the session starts. I mean, we should have a legislative strategy that incorporates some of this built in with your milestones, built in with the opportunity relative to helping, fill the 35,000 jobs we have open in North Dakota by providing housing for people.
Okay.
I'm
So
sorry,
I mean, this is all good news, but we got some work to do to build on this to help drive this engine up. There's no reason why we shouldn't be on the top of every one of these state by state charts. I mean, there's nothing stopping us from doing that. And that should be the goal, is how do we get to number one in all the areas we want to be number one in.
just one more point to add is that you all have been fortunate enough to not have to worry about volume cap, but as inflation kind of is setting in everywhere, and housing demand is just the dollars, I don't think volume cap is necessarily keeping up with housing prices. And so, it just takes a couple of big independent projects or whatever that suck up volume cap. And that's one issue that all HFAs around the country pretty much are facing is volume cap scarcity. So I know it's not a problem here yet, and hopefully it doesn't, but it could. And that's something to just keep an eye on.
We do have one request coming in that regard, about 120 to 125 million, likely to come in the first part of 2024.
Okay.
We're good. I mean, because we have carryover and, we're the only ones using it now, but that if you had more projects like this one, that would slowly erode.
Yep.
So we would ask to just be at least given an amount every year or so.
Okay, good. Well, Victor Ansel, thank you for coming to North Dakota. Thanks for the report. Thanks for the 20 year of collaboration. And Dave and team, congratulations.
Yeah. Thank you. Thank you. So we got, next up is Jennifer with report on the multifamily program allocations that we've just made and selections on projects. And Jen is on virtually because she is sick today. So she's being a trooper and still coming on here. So take it away, Jen.
Looks fine.
Why, thank you. Boy, it's always hard to follow Ansel and Victor because they have such great things to say about single family, and I get the benefit of the profitability to fund our grant programs, which are my favorite programs to manage. But that is not why I'm here today. I'm here today to report on the multifamily application award summary. And so this is our annual multifamily application round, which we have streamlined to be a single application round funding the home program, the housing trust fund program, our big low-income housing tax credit program, and the state's housing incentive fund. We've all of our allocation plans are separate plans, but they are applied for at the same time to help streamline and make it efficient for our applicants to have multiple funding sources that they need to get these projects to fruition. With that said, just a very brief background. We were oversubscribed by all of our programs, except for the Housing Incentive Fund, and I'll explain that in just a minute. The low-income housing tax credit, we have the small state minimum, and this year was about 3.7 million credits. We received requests of 7.6 million. So almost $4 million oversubscribed. The home program, we receive a small state minimum of $3 million, and that's been about the same for the last 10 years at least. We received requests totaling 5.8 million. So again, 3 million oversubscribed for the home program. And then the Housing Trust Fund, which has been around since 2016 and is funded $3 million, small state minimum. We also have not had a difference in funding except for 1 year. We received just a little over $3 million. But with that, we were $2.8 million oversubscribed on that program. For the Housing Incentive Fund, we made available up to $12 million, and we received 8 applications requesting 7.7 million. So we did not receive an oversubscription of application requests for the Housing Incentive Fund. There's a couple of reasons for that, though. Number one, a vast majority of the applications that we receive request the low-income housing tax credit, which is the largest driver of our multifamily development, because it can bring in up to 65% of equity towards a project. We do not allow the 9% applications to request more than $300,000 for the Housing Incentive Fund. And we do that because we want the Housing Incentive Fund to be spread as far as possible. The low-income housing tax credit is a huge benefit and still has some gaps, but it doesn't have the significant gaps that our more rural projects may face. So we want to make sure that our big developers who are accessing the 9% credits are working as hard as possible to find other sources, and that the Housing Incentive Fund is the source of last resort. And then that reserves funding to be made available for our rural programs and projects, which we know have challenges using the federal dollars because of the federal red tape that comes with that. Also, the low-income housing tax credit, it's challenging to find investors that will service the more rural communities. So with that, I think that it is a good thing that we have Housing Incentive Fund left over, because it provides stability for our next application round, that our developers know there is funding available. Also provides stability for our rural communities who take longer to put together an application. So I am hopeful that we will receive more applications our next funding round in September of 2024. So now I'll briefly touch on the successful applications. The first one before you is the Gardenette Phase 1, 2, and 3, which is located in Jamestown, North Dakota. And it is a redevelopment of an existing project with 42 single-story slab-on-grade fourplexes. So it's 168 units. They are all one-bedroom units today. When redeveloped, it will be 150 units with a mix of 1 and 2 bedrooms and some 3 bedrooms. So what'll happen is that they will combine some of the 1-bedroom apartments to create some 3 and 2 bedrooms, which I think will make the property more marketable in the long run for larger families, and still maintain affordable housing and rehabilitating what's now considered, I would say, naturally occurring affordable housing in Jamestown. So this is a great project to just maintain status quo of affordable housing in the community. This project came in 3 phases, and it does so because it's very large. The 3 phases total about 58 million in total development costs. So in order to access all of the resources necessary, you have to divide it into 3 so that you can obtain enough low-income housing tax credits and other funding sources to make it work. So this project in total will receive phase 1, $1.1 million of low-income housing tax credits, phase 2, $1 million, a little over $1 million of 9% credits. And then phase 3 is going to be using 4% credits, which require tax-exempt multifamily bond issuance. That amount is unknown today, but will be coming through in 2024. And then $3 million of Housing Incentive Fund. So the 4% credit applications are allowed to request up to $3 million of Housing Incentive Fund, because the 4% credits can only bring 25% of equity towards a project. So it has a far greater gap than the 9%. Any questions on the Gardenette? Keep moving. Yep. Okay.
Yes, please.
Yep, Avalon at Mandan is the next project selected, which is a 25-unit row home project. All units will have a 3-bedroom floor plan to accommodate families and is located in, it's infill development. It's in proximity to both an elementary and middle school and is not far from the new Mandan High School development. So this will be a great project for families. The total development cost of $9.4 million. And this project received 975,000 tax credits. The next project is Next Senior, which is going to be located in the West Acres neighborhood of Fargo, and it's a 40-unit new construction senior community. 1 and 2 bedroom units, total development costs of $14.7 million. The project received 1.1 million in 9% tax credits, 1.5 in the home program, and 2.8 of housing trust fund. As you'll see here, this is the only project that received an allocation of home and trust fund. This is going to make it a little bit easier administratively because home and trust fund, being HUD funded, have a lot of federal administrative requirements. And so knocking that into one project reduces some of the administrative burden for not only staff, but other contractors and such. So that is the project that got most of our federal funding. And then our HIF only project is Dakota Apartments, CCI Apartments, which is located in Cavalier. This is a 2-story, 8-unit apartment building located in Cavalier. It's intended to replace an 8-unit apartment building that was burnt and never rebuilt. And so they had a loss of those 8 units and do need them in Cavalier. Housing Incentive Fund will be bringing in 1.7 million of HIF funding, which is over 50% of the total development costs, which will be for us to provide an exception because HIF today is meant to serve 30% total development costs, but we allow a variance for our more rural projects who cannot access some of the other sources and also cannot tolerate the debt, so they need 50% equity that HIF can bring in. So that is that program. We did have some additional awards. So the projects, there are several projects that faced financing gaps and are nearly completed and have submitted an application for additional funding. Those applications are required to compete with the other projects in order to receive the funding. But Jewel City, Boulevard Apartments, and Washington Court Apartments were all selected to receive additional funding. Jewel City is a project in Rolla. It's a 16-unit USDA rural development property. It received an additional home and housing incentive fund allocation in order to complete the project. It is had almost a $2 million cost increases based from the estimates. So the bids are coming in almost double what they expected. This is a lot to do with a rural community and struggles in finding contractors that are willing to go out to that community. Boulevard Avenue Apartments initially was proposed a total estimated of 16.188 million and is coming in at just a little over 17 million. This project is the redevelopment, a substantial redevelopment of the Baptist Home Nursing Care Facility into affordable apartments located on Boulevard Avenue in Bismarck. And the reason for the cost overruns are, again, it did start its construction during COVID and had some labor and materials issues that caused these increases. Also, there was a water main problem with the building that had to be replaced that had increased costs. And then finally, Washington Court Apartments received an additional commitment of housing incentive fund, and that is the rehabilitation of some public housing and transitioning to permanent affordable housing and out of public housing. It's located on Washington Street in Bismarck. And this last 300,000 will hopefully help them get over some unforeseen environmental issues that they had. Are there any questions? That is all I have to report.
The Washington Court also in Bismarck?
Yes.
Yes. Any questions for Jen? Thank you for that update.
Thank you.
What are the, for the next meeting, can you give us what the remaining totals are in your different accounts? We have, how much HIF we have left, how much, all of those things. I don't need it right now, but let's just get an update on how much you got left relative to the remaining of the biennium.
I can actually answer that right now. I have 4.3 million of HIF left and 0 of the rest of our money. And so we'll receive a reallocation of home, trust fund, and tax credits. I think Dave's answering this question now, isn't he?
Yeah.
Yeah.
Those renew annually, not biannually, so they'll be in January, those will reload.
Right, those are plenty of dollars.
Yep.
All right, thank you.
Thanks.
Any other questions for Dave or Jennifer or team? Okay.
One last thing, Governor, you had asked Karen about our advisory board members, and Karen, you handed that out, right?
Yeah.
And that was most of them have been with us on the board a long time. Some of it's statutory, the lenders, realtors, manufactured housing, are all statutory, and we have the banking, the private associations to appoint, or suggest those appointments, so.
Great. Okay. All right. Oh, yeah, if that's a spare copy, I'll take that. Oh, okay. Appreciate it. Okay.
Thanks, gang.
Thank you all.
Thanks, Thank you, Ansel. Okay, Lynn Helms, DMR, you're up. Commissioners, have 4 orders for approval this morning. 3 of them are well facility and saleable oil confiscations. The first one, case number 30460, is for WW Oil Field. And I'm thinking we'll do that one separately from the other 2, if that's all right with you. They WW plugged the Carpentier well, but then they never reclaimed the site, and they failed to submit the single well bond. Reclamation has never commenced. We are anticipating that we will foreclose or go for forfeiture on the $50,000 bond that they had in place. We had asked them to supplement that, and they did not. They're in bankruptcy. And in this case, we did have a tenant farmer up here, and he farms that little piece of land just to the east of the lease road that you can see there, and can't get his equipment in there because of a dike and the location of the road. He asked if he could go and remove that dike. We're going to do that instead, using the abandoned well fund and the bond money. The reason being, if he removes it and something goes wrong, contamination is found, that would disqualify it for future use of abandoned well plugging and site restoration funds, because it would be the farmer or tenant doing something that, potentially to a well that was completed after 1983 that might limit our ability to use those funds for any future contamination that we found. So we'll remove that dike for Ted, and then we'll move forward. So we would recommend approval of the order confiscating the Carpentier well. Second. Got a motion and a second. Any questions or comments? Call for the vote.
Commissioner?
Yes.
Attorney General?
Yes.
Governor?
Yes. Thank you. The other 2, case 30461 and 30462, are both wells owned and operated by NOAA Energy. They are bankrupt. We have confiscated their $100,000 cash bond. They have failed to plug and reclaim one site. I guess I should forward the slide. Oh,
I went too far.
Thank you, Reese.
Okay, there's one well and facility there, and then there is a canceled permit where they built the location, but never reclaimed the constructed location. That's the south box, the one on the lower side. So we have already confiscated the $100,000 blanket bond. We need to confiscate the wells and sites and proceed using abandoned well money for any overage in terms of the cost to plug and reclaim. So the two orders that we're recommending would confiscate the two NOAA energy wells.
So move.
Second.
Motion second. Any further questions? Call for the vote.
Commissioners,
Yes.
Attorney General,
Yes.
Governor,
Yes.
All right, thank you. The fourth case and the order that we're asking you to approve is for the next step in terms of codifying the oil and gas regulations, conservation of crude oil under 4302, as well as some tax certification rules that we have in place. I'll let Mark walk you through that process, but we've been in this process since September. And this will be the final approval of the rules, the modifications based upon a couple of comment periods and 4 hearings that we held around the state. And I'll let Mark walk you through the comments and the changes that we made.
And as Lynn said, we had 4 public hearings. The last one occurring on November 17th. The comment period for that one ended yesterday. We did get some last minute comments in, and we considered those and made some adjustments. We had 12 different individuals comment on the rules. We had 41 total proposed changes. Based on the comments, we modified 15 of those rules, and we withdrew 1. The rules are scheduled to become effective April 1st, 2024. The entire process takes about 9 months. So it's like having a baby.
not really.
So it's a lot harder for the man.
Yeah.
Yeah, I remember it well.
The comments we considered, I will briefly go over some of the significant comments and the ones that we changed. On the spreadsheet I handed out, the very far right column that's marked in yellow, that needs to get modified in the rule based on the comments we received. And there's one in green, and that one is the one we withdrew. The significant commenters were the North Dakota Council. They commented on a lot of the rules. And the other one was the Northwest Landowners Association. I'd like to touch on that first. They sent a cover letter in with their comments and mentioned that they were discouraged that the oil and gas division is in close communication with mineral developers and provides early drafts and language to regulate community, but refuses to do the same for its members. I have no idea where that comment is coming from. I drafted the proposed rule changes. I've been in control of this process the whole time. I have not shared them with anybody outside our agency. So I have no idea where that comment is coming from.
You responded in writing to them.
Did not. Yeah.
Not a bad idea.
Okay.
I would take not a bad idea as a recommendation from the Attorney General.
All right, thank you.
I mean, it just,
Yeah.
it's one of those things. I mean,
Understood.
it's one of those things. They say that, you're not the only one they said that to. So if people say that, you may as well reply and let it be known that we stand behind that statement.
Okay.
You know, we know you'll be accurate in everything that you relay.
We can do that.
So you had mentioned something else, that we only communicated with our members. Who are our members?
The Northwest Landowners Association members, I don't know
Oh,
who they are.
they're,
They're
okay,
members, yes.
They're members.
Okay.
They thought we should,
I misunderstood.
they thought we should provide early drafts to their membership so that they could sit down and talk with us about the rule language before it went out for public comment. And accused us of doing that with industry, which we did not.
No one does that. Government doesn't do it.
Yeah.
I mean, federal government, state government, no agencies I'm aware of. Okay,
Well, people understand that's the purpose of their comment period.
exactly.
As long as everyone has notice of it and review and evaluate all those.
So all parties have had equal time, correct, to access. Correct.
Um, First, one I'd like to touch on is, again, deals with the Northwest Land Association. They made this comment throughout our rules where we changed the role, we clarified the role of the director and the commission. The commission doesn't sign a Form 4, the director signs a Form 4, things like that. And they said it was resulting in a reduced transparency and public notice. But all we're doing is clarifying what the practical sector is. I wanted to address that. One comment we received was on our enhanced well recovery potential well bond. The Petroleum Council wanted to make it clear that well moved that bond, that's the only bond that's on it, would be double bonded. And so we did clarify that non-unit and unit wells, what bond they're on, so we did clarify that based on the recommendation. There also is an annual review for that bond for enhanced oil recovery potential status. The original draft had that shall be reviewed annually. They suggested we changed to may be reviewed annually. We agreed with that and made that change. Another significant comment was on the director's authority to grant verbal approval to build a location. They thought it was too restrictive. They wanted other events added in there for the director to grant verbal approval to build a location. We considered that comment, but the list that we gave is not exhaustive. It says it includes these things. It's not limited to those things. And the other thing we have to be careful with is if you have an unwilling surface owner, the only reason the company can get out there is with that permit. So we have to be cognizant of that. And so we did not change any language in there. There was comment on the risk penalty language. There was some confusion of whether we removed the requirement that it be in writing. That was not the intent of our rewrite. So we did further clarify that the election to participate has to be in writing. I think they'll be happy with that. We did get a comment that we should provide for electronic service, i.e. email for elections and notice invitations to participate. And with the current practice, you have to send it out with some kind of notice receipt required, whether it be a green card, tracking to one of the carriers. We're not sure how that would work with email. And quite frankly, this came in on Thursday or Friday last week. We just didn't have time to research whether that is a practical way to do it. It's something we put on our list for the next go around to see if we can investigate that, see if there's a way to do that tracking. Because if they don't meet the deadline, there's lots of dollars at stake, and you have to be able to prove that you were given notice. And the company has to protect itself by getting the green card back or the notice. Yep. And so we just, something that we'll consider for the next go around. We did, with the latest hearing, had the director authority to allow open top receptacles for fracking. We did receive comments from Continental Resources, and we took their suggested language and modified it somewhat to what we desired. And so that the original draft was based on the recommendation, so there will be no change to that rule, but we did base it on what they had suggested. Another comment we received was on cementing surface casing while the drilling rig is on the well. We had Petroleum Council suggest we change that requirement or eliminate it. But quite honestly, in our experience out in the field, there are certain areas of the state where there are strong water flows in the surface and where it requires significant efforts to get that under control. And without a drilling rig on the well is not under control. We did consider that, but with the couple of hours that they might save, we thought that was not worth the chance of endangering our surface waters, which is one of the main goals of our agency, is to protect the surface water in the state while we're producing oil and gas. So we did not make that change. Another one was on the safety regulation where there's these high pressure process vessels. One of the companies, Marathon, pointed out that we inadvertently in our draft had left a gap between tanks that are not high pressure and vessels that are high pressure. There was a gap in there. They pointed that out, so we fixed that and covered that. As I mentioned, on the pipeline rule requiring a third-party inspector for all aspects of construction, Cohen Council felt that language was too broad, poorly defined, and upon review, we determined that they were probably right. And a lot of the stuff that we had tried to cover was adequately covered in the rules, so we withdrew that amendment. Another one, we received good input from a logging company. We had required a bond log to be run at zero pressure, but there are certain tools that don't work well when they get close to surface because there's not enough pressure in the wellbore anymore for it to function properly. So we amended that to allow for the tool for the proper pressure to be applied. We received a lot of comments on enhanced oil recovery potential status for oil wells. The industry is generally in support, but the Petroleum Council thought that our language was too restrictive for the qualifications for these wells to become EOR potential well status wells. We consider their comments, but one of the things that is allowed if you gain that status, it's a 12-year review period before the surface owner can request a review of that status. And we felt that's a significant time. And we thought that the wells should be adequately constructed to sit there idle that long and not have to worry about endangering surface waters. One of the requirements in there was that it has to have surface casing into the pure shale, which is a direction the commission of our agency has been moving over the years, trying to get rid of these wells that don't have, they had shallow surface casing set in, which was legal at the time, but that was from 50 years ago. And another comment we received is from an operator who thought that that was too restrictive. They have a lot of wells in the shallow part up in northeast North Dakota, and that there are a lot of wells up there that don't have surface casing into the pure shale that are older wells. And one of the reasons they requested that is because they have this deep pressurization method they use to produce these wells, which they claim is an industry recognized method of enhanced recovery. And what depressurization is, from what I could understand from what they told us, it's just producing the well really, really fast.
Big pump.
And so you're pulling a lot of fluid. But that is not an enhanced oil recovery method recognized under our tax statutes or tax incentives. So we thought that we were comfortable with our proposal. And the other thing is they can always, we can grant an exception to every rule after notice of hearing. So if they do have wells they feel are strong candidates for this, they can request a hearing, come in and make their case and convince us that they should be allowed. The last one we got was from the Northwest Landers Association. They thought the language was offensive and will lead to litigation. He said 12 years is too long for a well to sit out there, and the commission can't authorize that. And our response to that is that the rule was adopted pursuant to House Bill 1272, so it's in statute. We didn't set up this status. It was set by the legislature, so we're just adopting rules to implement that status.
So is the only concern when you talk about groundwater or any aquifers within those layers, it's because of the impurities that exist within CO2, not CO2 itself? Because we drink carbonated water all the time.
Correct. And in the CO2, I mean, there was some emphasis for that, but quite honestly, a well that's drilled, 10 years ago today, if it's not drilled with CO2 in mind, it's not going to meet the construction requirements that a CO2 will have, such as corrosive or CO2 resistant cement, CO2 resistant casing. An oil well isn't drilled and completed like that, so they're not really a candidate.
That's cool.
And then the last thing I would comment on is our certification of restimulation wells. We received some suggested language on that, and we incorporated some of those suggestions. The language that was suggested didn't really change anything. It was just rewording of some things, but we did take some of the suggestions and incorporate those into our rules, and they were modified to incorporate those changes.
What's the appeal process, if any, when someone disagrees with your final determination on one of their comments or concerns? What are their options beyond that?
So the next step, of course, is that your office will review these to see if we went through the right process, but then the Administrative Rules Committee has the final say at the legislature. And in the past, we've had them put rules on hold or send rules back to us for reconsideration.
I mean, ours is a compliance review.
Correct.
Yeah.
But their review
Substantive review of that.
from the Administrative Rules Committee at the legislature.
Okay.
And so if they strongly disagree, they can appear at the ARC meeting and make those objections, and the committee may agree with them and remand it back to us.
Okay. Do they come back to you with recommendations, or are they just thumbs down and starts over?
In the past, they've always come back with recommendations, and in fact, a legislator or two would be assigned to sit down with us and talk about the revisions that they thought were appropriate.
Interesting. Yeah. That's probably infrequent.
Very infrequent. It's only happened one time in 25 years.
You guys are so diplomatic.
Well,
yeah, that's good.
It's kind of interesting too, is that the reason you start this process is because of law changes. The
Yes.
legislature actually initiated it. You have to have rules that comply.
Yes. But we do, we're one of the pioneers, amongst the IOGCC states of frequently looking at all of our rules and putting it out to the whole staff and saying what rules are getting in the way, what red tape can we get rid of, and what rules do you need to make things better. So we always start with that in the beginning, as our entire staff.
Good best practice.
Thank you. So the order that you have before you authorizes these rule changes to go to the Attorney General's office for a process review, and then they'll go to the Administrative Rules Committee for final review.
So moved.
Second.
Motion second. Any other questions? Call for vote.
Commissioner?
Yes.
Attorney General?
Yes.
Governor?
Yes.
Thank
Motion
you.
carries.
That is the end of our agenda. Under other, Mr. Wrighton, did you have an item under other?
We were going to, under other business, John is going to give an update on that one.
Okay.
Working topic. Thank you, John.
With Lynn's input as well.
Oh, good morning.
Yeah.
Good morning, Commission. Wanted to give you kind of a last update of DAPL. As you are aware, the final comment deadline is December 13th. So this will be the last time to kind of brief the commission before we will be submitting those comments. So I want to make sure you're aware of kind of where we're going. When this started, about 5-6 months ago now, and really in the last couple of months, so we kind of had a small team working on this, and now it has turned into a lot of people and a lot of different moving parts. Some of the state agencies working on this kind of in this final stretch, Department of Ag, Attorney General's Office, Governor's Office, obviously, but also PSC, OMB, Trust Lands, DMR, DOT, Rio, Millen Elevator, Bank of North Dakota, SHPO, DEQ, DWR, just to name probably the majority of those. So those are all the different organizations within state government contributing to this final comment period. Since the last time we discussed, DMR has updated some of their projection numbers for where production will be pre-DAPL and possibly the post-DAPL. So I don't know if, Lynn, you want to discuss that a little bit about why our production numbers have changed.
Yeah, just very briefly, we had really strong months, August, September, October, November looks strong as well in terms of production growth. I think in October, we had a 4.5% increase in oil production and a 4% increase in natural gas production. So we're right at the threshold of 1.3 million barrels a day. So we updated our production estimates to 1.3 going into the May decision for DAPL. And our projection actually shows that we could grow to 1.4 or 1.5 if we didn't have the natural gas limitations that we have for processing and NGL exports. So we sat down with Justin and worked through all of that and realized that we are actually limited with our current infrastructure to 1.32 million barrels a day. That means that some capital has to flow to North Dakota for additional processing and gathering and natural gas liquids export and also natural gas export if we're going to continue to grow our oil production. But we went to 1.3 for the projection, and so that will impact OMB's analysis of the loss of 600,000 barrels a day of transport capacity, as well as the increase of about $2.50 per barrel coming out of that on 1.3 million barrels a day, and how that might affect jobs, how it affects the mill, how it affects tax revenues. I mean, it literally touches the pocketbook of every North Dakota citizen for at least 10 years. And we're actually running a projection for an unlimited period of time, providing an annual projection of what that $2.50 impact would be at 1.3 million barrels a day. But we felt like we should run it at 1.3 because the infrastructure is not there to handle the natural gas to go above 1.3. We hope to attract it, but it's not there.
Your number only reflects direct impact. What about the indirect impact because of the cost that's going to be incurred in transportation, processing, manufacturing, ag production, development, infrastructure? Because once the price of energy goes up, it impacts the rest of our lives and even our personal lives with and the quality of our lives with heating, cooling, energy costs, electric generation costs.
You're right, Commissioner. And so from my aspect and from OMB's aspect, we can only analyze the direct costs. But the Bank of North Dakota is running the REMI model on the secondary impacts of those primary losses. And so that'll be incorporated in the comments as well as to what are the secondary impacts that flow out of that $1.5 billion loss, I think is approximately what we're at for
Yeah. About
for the
1.1-ish, but then we look at, the other big impact is like with the Common Schools Trust Fund and with the Legacy Fund is the initial impact is going to take a lot of money out of the Legacy Fund and Common Schools Trust Fund. So they're going to amortize that loss, over the next 4 or 10 years to see, what is that loss going to be for the Legacy Fund for the dividends that are paid out of that to the legislature.
One of the surprises that came up was the impact on the state mill and elevator when all of the crude oil got on the rail, and how many times that they were not able to get rail cars to bring in grain or to ship out flour or products. And so we were able to look back at the 2014, 2015 era pre-DAPL and see what the impact would be even on the state mill and elevator. And it's very substantial. So that of course will ripple through all of our ag community.
Well, it affects every elevator in the state, then it affects every processor in the state, so it affects every farmer in the state. So those are part of the indirect impacts. But we should just elevate for 1 second and understand the thing that we're talking about, and we have a whole of government approach to fight back against, is unprecedented because there's never been an effort to try to do an EIS process on an existing piece of infrastructure in our country that is legally operating and safely and was permitted. Everything was all good and go. I mean, take any other piece of infrastructure, take any other private sector operating business has been operating safely for 5 years, and then say that politically we're going to come in and redo an EIS on you and we might shut you down.
And it's adjacent to an existing pipeline that exists
Yes,
and has been operating for 30 years.
right, in an existing infrastructure corridor.
Yeah.
And that's the 1 mile of the entire length of Dakota Access Pipeline that crosses federal nexus. So they're using that 1 mile of federal as a political leverage point to open this whole thing up. And there's nothing more. This is not about the environment. It's not about safety, but it's going to have a massive direct impact, including on MHA Nation, correct, one of the largest tribal energy producers in the country. So it is, I applaud the work that we're doing on the across using the whole of government approach, and I'm glad that you throw in DPI on that list because this will affect every school kid in the state if we do that. But it's going to affect, I said, every school kid, every farmer, and every aspect of what we do. The other thing, which I believe is unprecedented, is when they came out with this, there's no recommended alternative. We're being asked to comment on 5 alternatives, not a recommended alternative, and 3 of the 5 recommended alternatives include shutting the pipeline down. When again, there's no basis environmentally why that should happen, given I think we're at over 38,000 pipeline crossings of water bodies like the Missouri River in the United States, and this is the one that is being elevated for this political attack with the timing of next year, which happens to also be a presidential election year. And this whole thing blew up in 2016, presidential election year. So it's being used again. We're having a deja vu 8 years later of attacking a piece of legally operating infrastructure for political purposes.
Yep.
So fight on we are. This is one of 28, I think, that we're fighting the Biden administration on right now, right? In terms of rulemaking.
Lots of rules, and more rules every day.
Well, Lynn, thank you and your team for updating. Your question on we're capped at 1.3. We have to attract capital to do that. Capital flows to a place where there's stable regulatory environment. The act of attacking a piece of existing infrastructure creates instability, which then is one of the reasons why I'm sure the capital hasn't already shown up, because so it becomes self-fulfilling just by the attack itself. We're already being injured because capital may not be flowing here because they're like, how would we invest in more capacity or another gas plant here? How are we going to get the oil out? How are we going to get the gas out of our state?
Yeah, so it's a self-fulfilling prophecy,
Right.
where they attack it, and then the uncertainty creates the result that they were talking about. Right?
So we're attacking the U.S. energy industry. At the same time, the Biden administration this summer relaxed the oil export sanctions on Iran, the world's largest state sponsor of terrorism. And then about 3 weeks ago, when no one was looking, after the October 7th Hamas attacks, they relaxed the oil export sanctions on Venezuela.
Sweet.
So they've added 2 more, and then we've got our Swiss cheese ineffective sanctions on Russia. So Russia, Iran, Venezuela, 2 autocratic, dictatorial, brutal regimes. All three of those are all now putting more onto the market, which is flowing to China, the world's largest importer of oil and gas every day. So it's just the whole thing is absurd, because we're helping dictators who are destabilizing the world, but at the same time, we're attacking North Dakota and the U.S. energy industry.
It's remarkable.
It's unbelievable, really, is what it is, but that's exactly what's happening. Right.
So I appreciate John's efforts. It's been all hands on deck, and as he listed out the agencies, as we progress through this thing, we started to see more and more and more impacts. All of that will be incorporated into the comments. Hopefully, we won't end up having to litigate this, but it'll all be well supported and documented if we do.
Sounds good.
All right, thank you for your time.
Thank you. Next up, State Energy Research Center. Tyler.
Nice jacket. Hop here.
Did you loan that to Tom?
Yeah, I never had a basket. I was looking for a couple for tailgating, but I never.
Last year when I presented, we got on to talk about Christmas suits, so I promised I'd wear one of mine.
Yeah.
Unfortunately, I can't fit it over my cast right now, so let me get the top hat.
Well, thanks for joining us. So this is the annual report for the State Energy Research Center. First of all, thank you for all of your support in the past and for working with us on what we call the NDIC directive funds, which I'll get into in a minute. Slower than I thought, sorry. Just quickly, I always like to start out with our mission, only because we talk about leading the world in developing solutions, but those solutions typically start in North Dakota. That's where where the vast majority of all of our focus is today. And we take these ideas, advance them in North Dakota, and then where appropriate, look for ways to advance them outside of the state as well. Where the State Energy Research Center came from, so we're about 4 years roughly removed, almost 4.5 years now from the initial funding being available for this. But in the past, these blue bars are the federally directed dollars that we received at the EERC. Of course, they went away in 2010. And the green bar is the number of what I track as invention disclosures, new ideas, new concepts. During earmarks, we averaged about 15 different invention disclosures a year. They had peaks and valleys over their history, but you can see down into 2018 is when we ended up with really actually zero invention disclosure. It did not mean we weren't doing great work for the state. I believe we still were, but we were focused on applied research and not going back and coming up with new ideas and new innovations that would really benefit the state. That's what the State Energy Research Center was born out of, creating those new ideas and new concepts. Another way of looking at it is we always refer to our funnel diagram. It takes all sorts of ideas to come up. Only a few come out the back end. We know that. There's a lot of failure and risk associated with very fundamental research, but it takes many ideas to generate a few big ideas that make a difference. And we are so fortunate in this state to have, of course, the lignite, the oil and gas, the renewable programs. Now we have CC as well, and really the State Energy Research Center is that very early stage, new ideas. To steal a DARPA quote, ideas that are one miracle away from reality. You know, we're looking for some new breakthrough. That's primarily our focus. So that's what the State Energy Research Center does. As it was set up through the legislature, it's the primary focus. About 80% of all of the funding is spent on exploratory research, these new ideas, new ways of looking at things, new ways of doing things. We do set aside 10% of the funding. So in the past, that's been $500,000 per biennium at the sole discretion of the Industrial Commission. We look to you for your recommendations as to where we want to put those funds. We do have something we'll bring before you on that later today. So since our funding went up to $7.5 million a biennium now, so there's now $750,000 that we hold in that pot at 100% at your discretion. And then education and outreach, which our biggest program always has been the Energy Hawks. We are trying to work. We are trying to work with every institution of higher education throughout the state of North Dakota. Certain ones are more successful every year, but growing that program as well. And of course, this is run through a contract through the Industrial Commission. So
kind of the big summary of what have we done in roughly 4 years. In 4 years, we've advanced over 55 different ideas. And we put a plus there because sometimes we package multiple ideas into a single project or a single program, as we would call it. So it's 55 plus different ideas, concepts that we have been pursuing. Those new ideas have already related to invention disclosures. It should now say 9 patent applications, and it should say 4 patents granted. And if you live in the patent world where I do, getting patents granted this fast and this quick is not easy. We've had some really good ones that have made it through the system using the fast track process. So we've been very fortunate to have that. We've also taken these ideas. The whole idea, again, is to come up with these new fundamental ideas, early stage, and then we look for others, industry, federal government, to help advance them. So we've taken those ideas to date. We've gone out and written 29 million in additional proposals. We have had 10 million of that funded, and another 7 million is currently pending. So we've been able to bring in additional funding, the energy hots I mentioned, and then probably what I want to highlight this year is the $500,000 that was at the discretion of the Industrial Commission last year, what we used it for, and the great success that we had. And of course, you know, the hydrogen hub is the number changer there, but you know, approaching $1 billion that has come in from that $500,000 that we spent last year through the Industrial Commission. I will not promise that good of leverage in the future. that was a tough one to beat.
So what I'd like to see, Glenn just came in. The new threshold for Industrial Commission is a 2,000 times return on all of our.
Keep that in mind, Gil. I'm sure Mike's already on that.
So just to highlight the 3 proposals we really went after with the $500,000 we had. The first one was the formula grant, which has been awarded. And then the direct air capture and the hydrogen hub, which are both been notified of award, but we're going through all of the work on getting the contracts actually in place. This first one, the formula grant for grid resiliency, I actually had the pleasure of being the lead on for the EERC. So I was right in the middle of that one. We basically ghost wrote that proposal along with many other folks from your office, as well as from the North Dakota Transmission Authority. And we were very fortunate actually in the very first round of all of the applications to be funded. So we were one of the first. How many states do you recall? How many states? 4. So we're one of the first 4 to get that funding moving forward here in the state of North Dakota. Originally intended as a 5-year program. Right now, it's just the award was for 2 years, but we assume there's going to be 3 additional years, bringing in approximately $7.5 million in to be used at the discretion of the North Dakota Transmission Authority, and then of course this body making all decisions. And then there was a 15% cost share requirement from the entities. So, and this is strictly non-tribal. In other words, the tribal entities had to go after and propose their own. It does not mean that these activities could not happen on tribal land with their approval, but all of the tribes need to actually submit their own program to be able to get the funding for it. It's working well. I don't think we picked our first project yet.
So we have 12 applications totaling $17 million in asks. So we're going through a technical review process currently, and we'll have a recommendation for you at your December meeting. But wide variety of projects, anything from pole replacements to replacing overhead with underground poles, and using software AI to aid in inspection. So quite a wide range of projects.
Great. Look forward to that. The second effort that we focused on was the direct air capture hub, or DAC hub as we call it. In this case, it's the Prairie Compass is the name we picked. We were successful in winning a FEED study grant, which was I think $12 million, focused on getting ready for the next step, doing the FEED study, which of course the next step would hopefully be to put units on the ground here in North Dakota. Our partner with that is Climeworks, arguably the leader in the nation on direct air capture hubs. So we're looking forward to that, getting that contract in place. And then the idea is the timeline we've set forth is to have a first unit on site in 28, and then to build out from there with additional units from Climeworks. as well as we have been contacted by numerous other companies who are interested in piggybacking on the system for looking at how their systems operate.
Is there a cost comparison between direct air capture and then taking it off an industrial plant where you'd have high concentrations?
I am certain that there is. I don't know what that is though. And I'm certain it would not be beneficial on a cost basis.
That was just my gut. It was like, if you thought this was the issue, you'd keep doing it on ethanol plants in places where you've already got a pure stream as opposed to just trying to grab it out of the air. But
no question. It does have challenges economically.
But this is a federal,
Yes.
federally supported effort.
Yeah, federal $12 million. And then I believe there's a 10% contribution by Climeworks into it as well. So that's the direct air capture. And then I will turn it over to our newest employee at the ERC. So we'll throw him into the mix right away. Let Tyler talk about the DAC hub, or excuse me, the hydrogen hub.
New to ERC, but familiar with capital. So congratulations, Tyler, on your new role.
Yeah, I appreciate that. I know I work closely with the commission in my role at Basin Electric and look forward to continuing to do so here. But like Tom mentioned, he kicked me over to talk a little bit about the hydrogen hub. What's on this slide here, I want to take a broader approach and just demonstrate some of the vision of North Dakota's elected leadership, even going back before the hydrogen hub was even a concept, to just taking a look at the issue. The 2019 legislature obviously authorized the phase 1 salt cavern study that the Industrial Commission undertook. That was really a critical technology for enabling NGL management, natural gas downstream work. But it's also critical for the hydrogen economy. So there's a lot of foresight involved with that. And then, not to go through all those individually, but there's been a lot of states where to work since then, ultimately culminating in this award that was announced last month for the hydrogen hub. And also integral and parallel to that, I should mention, is the state's leadership in carbon capture technology, which is major enabling technology for hydrogen development as well. And I think it's fair to say that it's a major reason that this award was made. So that's kind of the broad overview. On this next slide, what you have is a depiction of the actual partners at the Heartland Hydrogen Hub, the projects they're developing there with the ERC. So you have Prairie Horizon, which is a partnership between Marathon Petroleum and TC Energy. They're looking at taking the existing Dickinson refinery, using both renewables and natural gas to produce hydrogen there. Looking at a number of end uses, ammonia, transportation fuels through the existing renewable diesel production there. Also potential of natural gas blending, and then there will be a CO2 capture component of that as well. And then the other projects with Excel Energy, they want to take both call it stranded power, renewables and nuclear to produce electrolytic hydrogen. Also looking at similar end uses, natural gas blending, ammonia, and industrial uses in the area. I think that's really the broad overview. Stop there if there are any questions.
We are hoping for that award. Right now, we're planning July 1. So as you can imagine, with something that large comes a lot of bureaucracy and things that we have to work through at this point in time.
From a cash management standpoint, do they write the check up front? Or is it people have to front it and then get reimbursed? I mean, have they even figured that out yet?
I don't know that. I think we do know that answer, but I don't think I do. Apologize. I believe you have to spend it to get reimbursed, but I will not promise that.
There's been a little bit of spend that's been authorized up front, but it should.
Okay. So that's really what we wanted to highlight, was those 3 projects. And of course, the first one was done entirely through the Industrial Commission money, and the third one, the hydrogen, we certainly had funding support from the other entities as well to write that proposal. But the Industrial Commission dollars that came through CERC were really the ones that allowed us to get started early and get moving on the program. So, I'm a little bit biased, but I think the State Energy Research Center has done exactly what it was called out to do, increasing opportunities for the state, increasing new ideas for the future. I look forward to it as it goes forward.
Part of doing great research is having great researchers. Is the flow of capital from, it's been around for a while, I mean, through LEC and Industrial Commission and now with CERC and Clean Sustainable, is that enabling EERC to attract and retain more and better researchers because they see that this state is committed to actually doing the R&D?
Yeah, so I can speak specifically about from the State Energy Research Center program. We're able to go out and find people with talents that we really really desperately need, and we have the funding already for them. And that's, when you come into it, even though we're not academic, you come into an academic world, you're always wondering about what funding you have to support you there. And so we can show them that we have State Energy Research Center funding that can support this and will help you. And then, of course, they had helped us to advance all the rest of our programs as well.
And same with do we have I'd say a human capital recruiting process coming off the back of winning the hydrogen hub where we can go pick off researchers from other places?
We are working on that plan as we speak. There's been a lot of discussion about it and about going after and doing exactly that. So I'm not in the day-to-day mix of those conversations, but I know a plan has been being developed for at least, well, since we were notified of the award.
Great. Other questions? Congrats on the success. Thanks for the annual report.
Thank you.
Thanks for bringing a little holiday spirit in here, Tom. Wishing you all the best in your recovery.
Thank you.
I got a fat tire version of the scooter that I don't need as of yesterday.
Yeah.
Might be on the market.
Yeah, the fat tire version. I got to see that.
For the winter.
Yeah. Yeah, that would be helpful. There are definitely challenges. We did have the one item within that $750,000, which is set aside at your discretion within the State Energy Research Center, a request for $135,000 of it. This is for the Bank of North Dakota Carbon Monetization Working Group. It came out of one of the working group meetings and was taken to the larger group, that it would be very beneficial if we took another look at CO2 availability and EOR as it advances and tried to come up with where we think it's going and how quick we think it could be implemented, how much, and then what the economic advantages to the state of North Dakota.
So move.
Second.
Motion second. And this is for the 135,000 for the enhanced oil recovery and incremental oil production forecast proposal. Any other questions? Call for the vote.
Commissioner?
Yes.
Attorney General?
Yes.
Governor?
Yes. Much needed and will be very valuable. So good investment.
Thank you very much.
Go now.
I know.
It's all right with you if I scoot around behind you?
Please do.
That's no problem at all. They get up. As you know all too well, that they do add maneuverability, but they are not perfect. Thank you.
Achilles or was it?
Big toe.
Fusion.
A lot of cash. That's all I've got to say.
I agree. I agree. Awesome. Well, a very Merry Christmas, even though we're a month away. So
Thank you. Okay, Reeves, renewable energy.
Yeah, thank you, Governor, Commission members. So we recently held our 52nd grant round of the Renewable Energy Program. So as I usually do, just providing you with a report for project management and financial before we get into the two applications. So only comment I'll have on this slide, Governor, Commission members, is that we're very excited to announce that we have a new hire coming on in the office starting Monday. We'll have Erin Steeg starting to be an additional grant administrator. So some much needed administrative help. We're really excited to have her on board, and she'll be starting on Monday.
Great, congrats. We're in her background,
She's coming from the city of Williston, where she was in.
Okay, great.
It's also providing you kind of the dashboard view of all of your industrial commission managed funds. And of course, where renewable fits into that. Digging in a bit more into renewable, you have 994,000 available today, the cash balance of 6.6 million. Also showing kind of the breakdown of where your commitments are. Of course, the vast majority being committed to grants that are ongoing, as well as your administrative expenses. And then your forecasted income, your legislative appropriation this biennium was for 3 million. And I'm showing here kind of the buckets and the source of all that income, of course, is oil extraction taxes, and that's all funneled through the Resources Trust Fund. So throughout the course of the biennium, of course, this will start to fill, but we anticipate that by January 2024, you will have already reached your cap of 3 million, and that'll be it for the rest of the biennium. So if there are no questions on that, Governor and Commissioner members, I can just briefly highlight the two applications.
And that was assuming 1.1 and we're already at 1.3
That's correct.
million barrels. Okay.
So you have two applications before you today. Your first one is related to recycling used wind turbine blades. They're looking into researching three methods for recycling wind turbine blades: gasification, milling the blades down and using it as a feedstock for 3D printing, and using it as a feedstock for manufacturing polymers. Your Renewable Energy Council recommends due fund of the full $500,000 ask by a vote of 4-1.
So there's two motions in one here.
Correct.
The other one.
Correct. The motions we drafted for you would include both, if that's the way you'd like to take them.
So would you want to quickly do the next one and then?
Sure. So your next project is related to the hydrogen hub, which you just saw that slide before from the EERC. I also provided this for you to help you understand which portions of the project are funded by which programs. The application for you in the renewable program would be for focusing on the carbon management side of it. So if you look at the slide up here and you see that number 2, that portion of the project would be funded with 100,000 from the renewable program. Of course, 3.2 million total cost, so a significant amount of private sector dollars going into this portion of it. Your number 1 and 4, that was funded by Clean Sustainable and the federal dollars. And then this number 5 and 6 would be coming before you at the January meeting. That's a future application for CC.
Related to the fertilizer piece of it. And on the 100,000 for the number 2, what are they doing, or what are we getting that we don't already know from existing, deep geologic sequestration that's already happening, say at a couple of the places where we've already authorized. I guess at Red Trail and Blue Flint, we've already authorized sequestration permits, and I know at Red Trail's already sequestering.
I think the big new thing here is most of your existing geologic sequestration for CO2 is typically in areas where you haven't had past oil development. This location will have pre-existing oil development, abandoned oil wells, things like that they're going to have to work around. So that'll be a bit unique in this project, that they'll have to focus on that aspect of it as well.
And that could be very beneficial where we're going with EOR.
Right.
Okay. Back on the prior one, on the recycling, is that a specific private sector company that is trying to set this up in to do this based in Grand Forks, or is that
So the project sponsor is UND, but I do believe they do have private sector partners that they're also working with as kind of a sub on the project.
And do you know when they say milling? Because you got a lot of fiberglass, but inside those, I believe there's a wood frame. It's like it's inside some of the blades. And so is the milling to take the fiberglass off of the wood, or do you know is that part of this process, or is that?
Yeah, I believe so. Part of the process would be to mill any of the useful components of that blade that they could then recycle into a feedstock that they could 3D print other products with.
Gotcha. Okay. We have one motion.
So moved.
And second.
And for the total of these is 500,000 for one and 100,000 for the second one. So this is a motion for a total of 600,000. Okay. We have a motion and a second. Any other questions or comments? Call for the vote.
Commissioner?
Yes.
Attorney General?
Yes.
Governor?
Yes. Motion carries. Okay. Welcome, Mike.
This is a sample I can pass around while Lisa introduces the project.
And feel free to introduce your team too as well, Mike.
Yeah. So after we go over one project, we've asked the Thunder team to come and do a presentation and update because they
The
recently.
project formerly known as,
What's that?
project formerly known as
Okay.
the Minn Kota project.
Yep, yep. So that can be part of the discussion, and Andrew would agree to give a brief update on what they learned in both their pre-feed, feed, and crest studies. Let you know where they're at.
Super.
So. All right, Reese, you want to kick off the project?
Sure. So similar to renewable, I just had also provided you the project management financial update. So I'll skip over some of this that you've already seen, but just focusing on lignite, you have 1.8 million in uncommitted dollars available today. So more than enough to cover the ask for you today. And similar to the other research programs, the funding source for lignite, of course, it's a mixture of both oil and gas and lignite, coal conversion and coal severance taxes. So throughout the course of the biennium, of course, we expect this to continue to fill, but your appropriation was 18.5 million. So we do expect that we'll fill to that amount by the end of the biennium. Well, there are no questions on that.
So we put the
That slide that you just showed in our deck,
It is under attachment 30. Page 5.
Right.
And that one pager should be in there as well. And so we've got a good split of projects. We had a lot of the funding was focused on the carbon management side, capture and storage. And now a little bit of that ratio has gone down because we just completed and closed out the two Minn Kota projects. And so, but number wise, we have a lot of projects on the emerging markets like rare earth, carbon products, and the various emerging markets. So the project that we're reviewing today for your consideration is titled High Value Products from Produced Water Mineralization through Reaction with Man-Made CO2. And it's an ask from the Industrial Commission of $100,000 for a total project size of $356,494. And it received, so it's focused on taking either produced water or water from one of the processes in a power plant or water that you extract out of a saline formation when you inject CO2 to relieve pressure. And it then mineralizes it by capturing CO2 and can tie up the lithium, the sodium, calcium, and other components. It had a vote of 15 in favor, 1 against, and 1 abstained. And so good leveraging of the money. And then the contingencies are I review their project management plan with them before they begin, as well as and include as a technical advisor on their project meetings.
So move.
Well, second, with the title like that, you can't vote against it. Who's against that?
Yeah. Yeah.
I wonder everybody.
Is that the handout you just passed around is?
Yep. So that's an example. The other small sample they had was backsplash tiles. So that's one example of what they can make with it. And then 30% of this by weight is CO2. And then they put a resin around it to protect it, just like they do with their coal building materials and ash building materials, same resin.
And what's the sort of durability equivalent of, I mean, if you were going to compare that to some other man-made or natural thing, if you're comparing it to like Formica or granite or something, I mean, it's got similar characteristics and think that it's similar.
Yeah. So the expectation because of the work with the same resin with the coal and the ash, is it'll have better compressive strength as well as flexural strength than the materials it's competing with in the market. Concrete block replacement had a very big improvement in strength. So it's all looking really good. And this is the first stage for this aspect of the building materials. So I'm pushing really hard that they focus on economics, because in the end, what's the clear path to application? And economics always plays the key role.
So what's tell me about this SEM Plastics. Where
Yeah.
does that fit in here?
So they're the company that owns the intellectual property, and
Okay.
they're heavily engaged with EERC on not just this project, but also their work on the cylinder or concrete block replacement, roofing tiles, wall materials. And they're currently on the other project building a truck mounted miniature house that they can show off, and they want to get a system built in North Dakota to build a lot of these building materials, but they're out of Florida and they have another subcontractor out of Morgantown.
Just seemed a bit, how would I say, maybe misleading when, it sounds like a plastics company involved in this project. And I'm like, did we redefine what plastics are? But
Yeah. So their epoxy resin is key to this. They got the cost of that resin way down so they can manufacture it and replace these materials at a competitive cost. This is the only one they haven't given us the initial economics on, but the others, they all show very favorable. And not only is the strength better, but it's all lighter weight.
Yeah, I was gonna say it's lighter, much lighter than you
had
just holding that small sample.
Yeah.
The concrete block market's a big market,
Yeah.
but this is, I mean, I would say surprising, but that they would have something that has got that finish quality to it, because you think it'd be easier to get to a concrete block that's buried in a wall that no one's ever going to see versus this thing as an actual, would start competing with other products for finish work.
Yeah, I agree. The big market definitely is the mass structural materials. But this one, they've got the DOE funding over 2/3 of it because of the interest in CO2 abatement.
So where did they make that sample right now? Is that?
This one, they just did they did a cheater version of the flue gas by combusting, I think it was propane, and putting that through a brine and making the material, and then taking those fine mineralized particles and putting it through their epoxy resin and making this. So, but with ours, they're going to do everything from captured CO2 to straight flue gas.
Where, would you envision this is, where in North Dakota do you think if they would set up shop if this thing gets commercialized?
They're talking very closely with all the mines. I think most of their discussions have been with Falkirk up north of Washington.
And the CO2 would come from?
From the hope is it would come directly from the flue gas, but otherwise it could come from CO2 removed from the flue gas or ethanol
Or it could come from Bluefluent or whatever. They got
Yep.
multiple sources there.
Yep.
Gotcha.
So.
Okay. Exciting. Yeah. Is in there's construction materials, is anybody working on road materials?
Yeah, so the other project we have with AmeriCarbon's the name of the company, they were looking at smaller markets, and I said, wait, what about asphalt? So now they're pushing really hard and seeing a lot of potential with asphalt, because that would be a lot of material versus carbon black or carbon materials. The asphalt, we all know how much of that we use.
Yep. Cool. Okay, so were we doing these together?
Just the one. Yeah, last one we had 7. This time only one project, but we got a big spring coming.
Okay, all right. And did you already make a motion in a second? Okay, so this is for $100,000 for the title that Drew really liked.
Good words.
Yeah.
Call for the vote.
Commissioner?
Yes.
Attorney General?
Yes.
Governor?
Yes. Motion carries.
So as I spoke with the Industrial Commission on the next topic, rather than an R&D update now, we decided we just finished 2 of the biggest projects under the program. So instead, we asked Andrew Sorbo to give you an update on the project that used to be named, formerly known as.
It is today. We can talk about changing that in the future still. So as Mike mentioned, just finished crest and feed work that was supported by NDSC, the submission, and LRC really helped advance the ball for us. And we spoke to Reese. What we'd like to do today, we just gave a very technical report on update to LRC. What we'd like to do today is really discuss Project Tundra, new target dates, where we're at, challenges, things we've obtained, and then, kind of last steps to get us to the finish line of that final investment decision. I'm Andrew Sorbo, Vice President of Strategic Initiatives for Dakota. Also Shannon Nicula in the room, Project Counsel and Geologic Storage Lead for Project Tundra, Commercial Finance Lead, and then Carly McLeod is with us now as well, External Affairs. So any questions on storage or permitting, pull her up to the table and do it. When we talk about Tundra, we always break it down. What we have been doing recently is breaking it down to 3 main buckets: capture, storage, and finance, all with their own unique set of challenges and risks that really have to be mitigated to lead to that final investment decision. So on the capture side, the main actual plant and certainly the most capital intensive portion of the project, we partnered with MHI and Kiewit. That was been made public. MHI, Mitsubishi Heavy Industries America, really on the technology and the design side, and technology engineering. Kiewit, they're actually going to build the thing for us. So MHI and Kiewit forming a consortium to work as one single unit, moving through final feed with MHI, the support from the crest and feed that we went through with support of the commission, and LRC really launching pad to allow us to expedite the second and final feed with MHI and Kiewit, and really bring us to the point we're at today. Normally, you get done with the feed and you end up with 20-30% contingency, plus minus. What we're doing with MHI and Kiewit is in parallel working on and negotiating actively now a fully wrapped lump sum turnkey EPC contract. So at the end of the finish line, which right now is we're targeting April 1st, you'll get an LSTK price. That is not a contingent price. There's no plus minus. That is the price, which is what will allow Dakota, DC Energy, and potentially other investors to make that final investment decision by the end of Q2 24. On the storage side, this is not a secret to this commission. We've been very, very successful in large part due to the support of the state. Our permitting and storage efforts led by Shannon and a host of other support we've had. Largest permitted CO2 storage facility in the country. Just received permit orders on our second site. Really enjoy the support we have from the local communities and local landowners. That is not 100% across the board in all projects of similar nature as you look across the country. So certainly something we really enjoyed. And then the coincidental location of the geology and pore space, that is the Milton R. Young Station. And just on the bottom left of the screen there, the blue rig, that east storage, or east pore space storage for Project Tundra. That will be a very short pipeline, about 400 yards, short par 4 of pipeline to get to our main injection site. So literally storing CO2 directly underneath the plant. On the storage on the right side of the screen in the green, that is our east storage permit first, the main storage required for Project Tundra, 19,000 acres, 97, actually I think it's 98.5%. Landowner consent, voluntary, very supportive group. And on the west, just have orders on that now. We'll move into the MRV stage with EPA, 29,000 acres, and see large support for that one as well, over 80%. So 100 million on the east side, 200 million of CO2 tons capacity on the west side, 222 million metric tons of capacity over 20 years between the east and west. And then from a finance perspective, also public, and we're really excited to announce the relationship that we have now with TC Energy. not unfamiliar to the state of North Dakota. A lot of assets in the state of North Dakota, also involved in the Liberty Hydrogen Hub, pipelines, and then have a lot of capital. It's a capital intensive project. This is the kind of investor that you need. But TC is really much more than just a pure financial investor. We view them as much more strategic investor. We signed a joint development agreement, and TC Energy and Dakota in parallel are pushing the project to the finish line for final stages of development. TC Energy also owns a lot of generation. So when we talk to them about something that's critical to Dakota, station does not change with the implementation of the capture facility. When we speak to them about MISO intricacies, capacity intricacies, the ability to respond when the grid requires that power and provide that reliable baseload power to our membership and to the grid, they get it and they understand. So it has made it very easy to work with them in trying to sort out exactly how all that's going to work. We've received some incredible financial uplifts as well on the federal and the state side. 45Q, the uplift from $50 to $85. That $35 incremental uplift really isn't gravy on top. When you look at supply chain issues, inflation issues, which everybody is dealing with, that $35 uplift was really required to meet the financial metrics required for a project like this to move it forward. Project Thunder, project formerly known as Project Thunder, Dakota's project, carbon capture project, has applied to the DOE, part of OSED's demonstration program. They're allocated funds from Congress specifically for coal carbon capture. We're up to 2 projects, $350 million. We have applied for that. That is not money in hand. We have not received selection notice on that. We are expecting selection for that $350 million before the end of 23. I'm actually expecting it open for it this week, but it is the federal government, so we will see. And I, of course, don't need to tell this group what the Clean Sustainable Energy Authority is or what the intended purpose of that was, but under leadership from the state commission and Senators Bosch and Patton, we were able to request and receive cumulatively $250 million in the last 2 bienniums in a low interest loan, which is really precisely the type of low interest capital required to move this project forward. And then we have other obvious advantages that have not been through the works of Dakota at all. Ideal geology. Clearly, the state is well positioned from a geological perspective when it comes to pore space. We're very fortunate that it's located directly underneath our power plants, making that obviously ideal. And then from a policy legal framework perspective, the state of North Dakota is really the leader in that in the nation, setting up the groundwork. And I think other states are trying to follow, but it takes time. And this was a 15-year effort by the state, and we're very appreciative that framework was there. It made all of this possible. It allows us to sit here today as certainly the most advanced project of this nature in the country. Classic storage permitting primacy, huge advantage. You still have the EPA MRV plan on top of that, but huge advantages from timing and familiarity perspective. And then, of course, as reference to support from LRC and this commission, early stage funding to bring us to this point. Over $25 million in funding to get us to the point that we're at today, and very appreciative of that. Support of local community. We've done that through constant communication. Also, the local community and the landowners that we're working with understand the obvious importance of Milton Young Station, B&I's mine, but then also understand that we're all living in and will continue to live in a carbon managed world. This is one solution to allow us to continue to operate in that world. The expanded 45Q makes geologic storage financially feasible and economic from a financing perspective without the dependence on EOR. We're supportive of EOR. We know that's a goal of the state as well. And we think this will open up opportunities for future EOR potential, but really the tax credit financial certainty of that cash flow is really required for a capital intensive project like this to get the early stage financing and capital raise. And then incredibly supportive board from Dakota and our leadership also clearly required to advance a project of this magnitude. So what's next for us? So complete final stage of FEED, and then in parallel the EPC fully wrapped LSTK contract, the West Side MRB with EPA, hopefully achieve the DOE grant, and then from now until April 1, it's really an incredible amount of due diligence on all fronts, including line of financing. Trying to move this to a point where one, when we get that price, Dakota, DC Energy, other investors will be in a position to make that final investment decision on go, no go.
What's your confidence level in getting an affirmative on the DOE $350 million grant?
We're very optimistic, mostly just due to the advanced nature of the project. The fact that we have storage is a huge leg up on every other project. So from a competitive standpoint, we're very optimistic that we'll receive those funds. Also, we want everybody else to be successful. We're not trying to be the biggest forever. If Rainbow can accomplish the same thing, they'll eventually 2X's. Right? So we want this to be a launching pad for others. So, but at the same time, we really need that capital, first of its kind, first in the world. To have primacy in that just naturally requires more capital than you do for the first time at that scale.
Is the 350 grant, how is it paid out over time? You have to spend the money up front and then they reimburse?
You got to spend the money up front and they reimburse it. They have it broken out into 4 phases. Phase 1, 2, 3 is the construction phase and 4 is post-construction. Really, from when you look at the DOE's requirements for phase 1 and 2, from an engineering and technical perspective and storage perspective, we're through phase 1 and 2. There's other requirements that we will have to do in phase 1 and 2, but really we're at a shovel-ready position or near we'll be in phase 1. So, and that's the purpose of the
Will you be able to be reimbursed for expenses already incurred through what you consider phase 1 or phase 2, or does it have to be new spend?
To some extent, we may be able to get reimbursed. That will be negotiated. If we get selected, we'll move through a negotiating a cooperative agreement with the DOE. And part of that will be potential escrow reimbursement on spend.
And remind the commission what the annual amount of storage would be in metric tons when you're fully operating?
Fully operating, we can do 4 million metric tons a year. For 12 years is the tax credit period. So those are the 12 years we use for all of our economic models. We don't go beyond 12 years. The way we do storage is for a 20-year period.
But at the end of 12 years, you could be selling that for EOR.
Correct.
Or selling it to people that are building materials next door to you. Okay.
From a schedule perspective, we like to use this one because in the middle there.
Question, do you know on the 45Q, there's the 2 rates, one's for storage, the other's for EOR.
Yes.
At some point in your flexibility with your financing models, if say, before you got to 12 years, say you're 8 years out, EOR takes off, people are willing to pay that differential equivalent or more, where it'd be more economic for you to sell to EOR and take the EOR credit than the sequestration. Do you have the flexibility to do that, or are you locked in for 12 years with sequestration only?
Yeah, no, that's a great question. Economics obviously drive almost every decision that gets made. I'm not sure if I don't believe we're locked in to permanently storing and sequestering it. It's just if you want that bracket of 45Q, then that is what you're doing. But if you're willing to move to the 45Q covering EOR at the different rate, or if the incremental is covered, or if that makes more economic sense at that point in time, then we'd have the flexibility to do that today. Yes, but it's Dakota, it's TC, potential other investors, so that would be a project decision at that point.
Yeah, you think you'd want to build in that optionality because you might find before 12 years, you might find that, hey, 25% or 50% of this should be going to EOR. It would have higher economic value than sequestration, or these guys might be willing to pay for it. These guys, I'm pointing at the building materials. But I mean, I just think having optionality in these contracts, because you could find out, like in a lot of these things, the economic value might exceed the tax credits if these markets start to unfold.
From a schedule perspective, this timeline starts in 2015, which is when Dakota started examining this and putting the effort in. On the bottom there, October, November, in the blue, that's where we are now. Orders received on the West permit, filing our MRV plan, and then in December, continuing negotiations on EPC contract. Again, all the due diligence, all the work over the next several months is going to lead to that April 1 target date.
Given that this administration tries to screw with anything related to fossil fuels, do you expect on the MRV you said requires EPA approval? Are they creating new hurdles on that as a way to block?
Maybe want to bring Shannon Mikula to the table if you want to discuss the issue. I'm not sure.
So we've had conversations with the EPA, and it's their specific reporting program, the greenhouse gas reporting program that manages the MRV plan. We've had ongoing conversations with them in preparation for filing. We don't foresee any impact from that program at this point. They're just about 6 months behind in terms of start to finish of processing an MRV plan.
And so when we would anticipate that when you submit that it could be 6 months before we hear from them?
No, ongoing. So it would be 6 months before a final kind of sign off on your MRV plan. It's an iterative process, just to review any clarifications, additional information needed in the MRV plan.
But you have that for the east. This is for the west.
Mm-hmm.
So there's nothing that's slowing you down if they try to mess with this and stretch it out. There's nothing that stops you from charging ahead.
That's correct.
Correct. The west side is really nice from a redundancy perspective, potential third-party market perspective. Having it there for Tundra if needed, but it is not required. Certainly not from a finance west side.
And it could take all of the offtake, the 4 million, it could take, one site could take all of it. You just would have 10 years versus 20 years. Are they similar in size?
So even at max output over 12 years, that'd be 48 million tons. Into the east side, we have 100 million tons of capacity in 20 years. So the east side can handle.
Okay. So I'm just trying to eliminate risk, but the EPA can't try to mess up this permitting process like they do other things and slow this thing down. We can keep charging ahead full speed.
Yeah, we still have our air permit to construct pending with the DEQ, and EPA Region 8 did comment on our application, and the draft permit comments were fairly expected and nothing of surprise. So that is a permit that's still pending. And we certainly have with the OSED DOE funding opportunities that we're going after a NEPA environmental assessment that is in a draft form today. So that's one other point where we've had EPA comment on those.
In the target end goal, how much CO2 will you capture as a percent of the total emission coming off the plant?
So the way we try to articulate it is by unit and then also by station as a whole, because it's a 2-unit station. So because of the flexibility that we've designed and engineered into the project, we can pull from either unit 1 or unit 2. The principal unit that we're designed for is unit 2. And the CCS system max capacity can take about 530 megawatts of flue gas. Unit 2 is a 457 megawatt generating unit, so it could take 100% of the flue gas off of unit 2, and the capture system can capture 95% of the CO2 off of synthetic processes. So you kind of look at it as 100% from unit 2 with about 20% of the flue gas from unit 1 as the principal mode 1 of operation. And then that can be reversed, and you can take 100% of unit 1 and about 40% of unit 2 to max out that 530 megawatts, unit 1 being the smaller of our units. On a station-wide basis, it's about a 74% reduction off of the baseline emissions as we projected forward.
Great, thank you.
That's the end of the update. We're happy to.
Great. Any other questions? Well, great update. Thanks for charging ahead on all you're doing, and good luck on the next phase. And we'll eagerly look forward to hearing positive news on your grant this week.
Thank you.
Thank you all.
Okay, back to Karen and Reese. We've got some administrative.
Yes, we have the October 31st meeting minutes.
We have a motion and a second. And are there any additions or corrections? Hearing none, we'll call for the vote.
Commissioner,
Yes.
Attorney General,
Yes.
Governor,
Yes, motion carries. We have the schedule, which is attached for 43 for 2024.
I'll move it.
Second.
I'll hand it to Jody when we get up there. It'll look like it works.
So we have a motion and a second. We'll call to approve the schedule for 2024.
Commissioner,
Yes.
Yes. And the last item we have is a compensation recommendation for Vance for the North Dakota Mill and Elevator.
yes, so typically the commission will address Vance's bonus in October and November. So it can be paid out in December. Just as a reminder, Vance's contract provides for a 30%, up to 30% bonus based on his base salary. The commission has recommended that that 30% be broken out into two components. 20% of that bonus is based on the gain sharing distribution for the rest of the mill team members. And then 10% is based on Vance's achievement for the mill's achievement under his leadership of the goals that are set forth in the mill strategic plan approved by the commission.
So another way of saying is 2/3 of that, of the 30% bonus are formulaic because they're driven by the gain share plan. And whatever the numbers tell us, that's what it is. And then 1/3 is the part that is more subjective related to his work on the strategic plan items, et cetera. Is that, am I understanding that correctly?
That's correct.
Okay.
So in fiscal year 2023, the mill did produce an all-time record profit, and mill team members did receive a record gain sharing payout. So for that component of Vance's bonus potential, I am recommending 100% of what he could potentially get there, which is $71,675. And then also you'll see in my memo, I set forth a number of very significant achievements that the mill accomplished in 2023. Very successful celebration of their 100-year anniversary, recertification under the Food Safety System Certification Program 3-year audit. They added some very significant customers that they anticipate will contribute to 7% growth of sales in the coming year. And then growth in their conversion margin of 16.8%. So those are some really key, among others, achievements of goals that have been set forth under the strategic plan. Some areas for continued focus that I've identified are leadership succession planning, acquisition or partnership opportunities, identification of acquisition or partnership opportunities, and then the implementation of the 4-shift operations that Vance has presented to the commission previously. So those are among some of the goals that Vance can continue to work on and leading the mill management team. So with that component of the bonus potential, I'm recommending an 85% payout of that component of his bonus, which would be $30,462. And so the total bonus for the 2023 fiscal year for Vance would be $102,137.
So move.
Second. Got motion second. Any other questions or comments?
I'd make a comment because I know some people are probably going, but in the private sector, he's $1 million CEO in a mill and elevator of this size. And it's the largest one in the Western Hemisphere. The fact we've been able to keep them all this time has probably been a big plus for North Dakota. So, yeah, this is a good deal for the state of North Dakota.
You're here. We'll call for the vote.
Commissioner,
Yes.
Attorney General,
Yes.
Governor,
Yes, motion carries. And I guess we can say with that, Karen, thank you for pulling all that together. But as we've shared with Vance in person, but a great year with the record profitability and record gain share. And, you know, when you're hitting 85% out of 100 on your subjective goals, plus managing everything we're managing, it's just a great year for Vance and for the mill and for North Dakota. So thanks for pulling that all together. Hey, any other business to present before the Industrial Commission today? Okay, hearing none, we're adjourned. Thank you, commissioners.